just one video
the ECB
away.
has obviously experimented
Remember,
taking
be
rates
clear,
into negative
be
territory.
passionate,
They work
and most
in theory,
importantly, be you.
in economic theory.
We can't
I
wait
think
to see
that's
what you've
worked in
got.
practice as well.
Let's
They've
get funded
certainly
now.
had, big impact, a strong currency channel. I think they also have a signaling channel. It's a step to take rates into negative territory, and no central bank does that lightheartedly, as the Swiss governor said. And so, if central banks do that, it says something about the path. And through all these channels, I do think it has an impact. And if I had to judge standing today, what is more likely coming in Europe in the future? Is it more QE or, again, negative rates? I think at the moment the pendulum has swung in favor of negative rates as being the instrument that probably comes with less side effects and can be reversed more quickly. And if I think back of my own time at the ECB when I was a staffer and thinking about these at the time unconventional instruments, the received wisdom at the time was probably the other way around. So, QE was a little bit more the favorite tool, and negative rates was really uncertain. So I think the fortunes have really turned a little bit in terms of the preference for these two instruments.
Zoran Rada, wonderful insights. Thank you so much, Zoran Rada of Point72. We really appreciate you being with us here ahead of that ECB rate decision. Coming up next hour, Peter Scheer of Academy Securities, Ed Mills of Raymond James, Holly O'Neill of Bank of America, and Mike Collins of PGIM Fixed Income, as we are about 1 hour and 15 minutes away from that key ECB rate decision. And in 15 minutes after that, PPI and initial jobless claims. This is Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in now a GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason I love thinking about black swans, and at the office everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Right now, the market is very happy with the fact that soft landing is still the story.
Sentiment is very positive, but I think sentiment is positive for a reason. You know, the economic growth's been surprising to the upside. My confidence in the economy next year growing over 2% is still relatively elevated.
It's really about this intersection between quality and value that we think can power markets higher into 2025.
This is a really good economy for financial markets. The question is, can we sustain it in 2025?
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. 75 minutes until an ECB rate decision as the focus globally shifts to synchronized rate cuts. We already got some from the Bank of Canada, from the Swiss National Bank. We expect a 25 basis point cut from the FOMC next week. And then today, the expectation is for the ECB to come out and deliver at least 25 basis points of a cut with probably some dovish language. Markets pulling back after yesterday, hitting a record high on the NASDAQ 100. It seems as though we are shifting toward an environment where people are on the margins, less concerned about near-term inflation and looking more to just how much different central banks around the world, Danny, can cut rates.
And we saw it from the S&P, 50 basis points. The issue is if they already need a cut now because there's economic weakness, what happens in 2025 when they face tariffs, when they face those external pressures, and they don't have the sort of firepower that they need, that the ECB is the only game in town to the point of soaring red, that you don't have some sort of cohesion among governments in Europe that can handle anything that might come down the pike in 2025. Thus, you get the S&P talking about negative rates because rates are already low and they need more firepower to deal with whatever next year might bring.
And why do they need more firepower? It's because of the currency channels. And what you can see is a Swiss franc that has strengthened dramatically on the weakness that you're seeing in the rest of Europe at a time where otherwise they want their exports to give them some sort of tailwind. This morning you are seeing the efficacy of cutting by 50 basis points, but Anne-Marie, we are going down to 0.5% with their key borrowing cost, which isn't leaving a lot left for potentially some of the tit for tat that we can expect.
And that's why you have the S&P coming out and saying they don't like negative rates, but they are effective, opening the door to potentially maybe in the future, especially if we are dealing with higher tariffs and we have a difficult export environment. Maybe we would have to go there into that negative rate. But it's not just central banks, it's governments. China today coming out and saying they're going to have more looser fiscal policy. The Commerce Department in China coming out and saying we would like to have a dialogue with the United States. And it's companies, Meta, donating to Donald Trump's inaugural committee, $1 million, not a ton, but it's the symbolism across the board. Companies, central banks, and governments getting on board and getting ahead for what's coming down the pipe next year.
And they are concerned. And again, I just go back to how much that contrasts with the animal spirits. Central banks are fearful they're taking actions. Company executives are trying to call Trump. Meanwhile, stocks are continuing to bump up against all-time highs. Meanwhile, every CEO survey is so optimistic. The small business survey sentiment is really optimistic too. There does seem to be a sort of disconnect with all those things, and not to mention a bond market too, which recently has been selling off.
There's been a real question here about how this time is different from 2016, in part because of the learned experiences back then and the fact that the world adapts and adjusts, whether it's central banks or whether it is companies. Coming up this hour, Peter Scheer of Academy Securities, a CPI boosts rate cut bets, at least near term. Ed Mills of Raymond James with a tax cut fight looming on Capitol Hill, and Holly O'Neill of Bank of America on the outlook for consumer banking in 2025. We begin this hour with stocks just slightly lower, led downward by the NASDAQ 100. Still yesterday, those tech stocks hitting a new record high, the S&P 500 snapping a two-day losing streak, boosted by mega cap tech as inline CPI all but ensures more Fed easing. Peter Scheer of Academy Securities coming back with us, saying, bottom line, the Fed cuts by 25 at the next meeting. It should be a neutral to mildly hawkish 25 basis points as the underlying data away from the unemployment rate based on back-to-back bad months in the household survey is likely to be deemed the outlier. Peter joins us now. Peter, thank you so much for being back with us. I want to get a sense of what you make of yesterday's price action. I know reading the tea leaves of the market can be a fool's errand, but it seemed odd that the initial reaction was to buy bonds, great auction, and then something changed.
You know, I think everyone really has these animal spirits. I think everyone's trying to look through this and say, there is a real chance that Trump cuts a lot of red tape, that he reduces regulation, that he promotes business. I think you're seeing stimulus from the rest of the world. I think at some point we might get worried that the rest of the world is going to slow down enough that it drags the U.S. down. But for now, I think it's just that excitement that kind of all this not in my backyard gets thrown away, and we actually see progress. We see, investment done. We see build-outs here. And I think that's real, and that's what's outweighing even the move in yields.
Well, it might be outweighing the yield, the move in yields, but what is behind that yield, that move in yields, given the fact that basically we're counting on a Federal Reserve to cut rates by 25 basis points next week, and you got central banks around the world that are chopping away as quickly as they can?
I think we are not going to see a much lower inflation picture in the U.S. Partly, companies are front-running some, tariff fear, so there's been buying on that. And if we are going to rebuild things in the U.S., which I think there's going to be a push, quite frankly, it's going to be more expensive to do it here than it would be elsewhere. Otherwise, we'd probably have been doing it here already. So I think there's going to be some costs associated with that. There's going to be a build-out in logistics. We're going to need infrastructure to do all that. So I think it's going to kind of keep inflation a little bit high. You're seeing the data centers grow, all those things. I would say on the equity markets, I see some froth. I'm a little bit nervous, but I think as we talked about earlier in the week, it's really hard to short anything in December, right? The seasonal, factors are in your adjustment. And let's also not forget, the amount of money that's been made in crypto in the last few months is certainly helping spur Christmas shopping or holiday shopping. It's doing everything. So, while Bitcoin kind of keeps going up and everyone's excited, I just think that feeds to that overall, we have to buy more of this stuff.
Yeah, I wonder what the housing market in Miami looks like right now with after that Bitcoin surge. Getting back to the central banks of it all, though, on the way up on the hiking cycle, there was this fear of diverging from the Fed because you want your currency to stay strong enough that you could continue to fight inflation. The opposite is happening now, and you have concerns from different countries about the weakness in their growth. Do you think that this is going to be a divergent cutting cycle, that you're going to see other central banks that want to get out in front of the Fed and have bigger cuts to them and frankly would welcome a Fed that maybe goes on pause in 2025?
Yeah, I think they want to do that. I think they need to do that. Again, Europe is kind of a mess right now, and that Germany, which had been the juggernaut and real the anchor, support of everything, they themselves are struggling right now. So that's going to leave the ECB job very difficult. And I've always thought that a big chunk of the tariffs, that if any actually get put on, will be absorbed by a much stronger dollar. And I think that's what we're seeing, right? This dollar strength will offset any of the tariff prices, and that will keep, that pressure lower than it would be otherwise.
You also said something moments ago, though. You said that the animal spirits are dependent on everyone believing weak growth elsewhere won't affect the U.S. At what point does that change?
Certainly probably not this month because everyone's kind of very focused on the holiday season coming up. But I think as you start looking to January and February, okay, like how long can we continue? And again, today I think I saw a headline from you that I think is going to be a bigger theme again next year is BYD is now, I think, outpacing Volkswagen in Brazil. And my view has all along been that China's trying to buy time to make sure they can sell their brands globally. So I think we get all excited about this growth and all the stimulus. And I think in the end, we have to be much more prepared for China trying to sell their brands globally, particularly into emerging markets, and more Europe. I think the European weakness plays to China.
Right, because if the walls go up on everyone, China's going to have to find a place to dump their exports. When it comes to this idea of potentially where animal spirits are starting to maybe wane, do you want to look elsewhere? Places like China, places like Europe?
Yeah, I actually think the Chinese stock market's somewhat interesting. It sold off after Trump, won, but I think some of that's going to be a mistake because I do believe that they really have to continue with the stimulus. They have to get their things going, and they're going to do everything they can to help their brands and therefore their stocks. I don't think it's going to be great for global growth. I think there's an opportunity in Chinese stocks as a trade, not as an investment. So I like that. I think around here, commercial real estate, that's become kind of more and more of a theme. I think, work from home is winding down. I think, the DOJ or whatever it's called is one thing. The Doge is very convinced that, and I think rightfully so, that all federal employees who are still working from home will be pushed into office. So I think you're going to see a resurgence in that. And yields, while they go higher, maybe you get to 450 on 10s with a potential spike to 5. You don't go below 4. I think a lot of commercial real estate can do well in that environment.
If you're a traveler and not a settler in terms of the China stock market, how concerning is it for you that Congressman Waltz, Senator Rubio, potential ambassador Jamieson Greer have all called for decoupling of China and the United States?
I think we should be somewhat concerned. Then, on the other hand, Trump supposedly invited Xi to come to the inauguration. So, again, I think everything with Trump is a little bit of a game, a lot of negotiations back and forth. I think it's in China's interest to remain as coupled as possible. I think long-term, we'd probably be better decoupling, but I think we'll get sucked into doing short-term trades that actually favor China over us in the long term.
Can you get into that more? Because you have a really fascinating view that you've been writing about for some time, that Trump could go for what looks like a win with China, but actually gives China an advantage in the U.S.
Right, so we see all the problems that Chinese economy is having, right? And U.S. companies do not want to invest in there. U.S. companies are kind of running their factories at a minimum there. So China, the only way they're ever going to grow is by selling their products. They need to buy time to do that, right? They're struggling right now, and I think they will come up with some deal that looks attractive to us and say, oh, this is perfect. This solves our issues. And then 3 to 5 years down the road, we'll regret it because it'll have given China time to continue to build up their manufacturing, to build up their chip industry, which I think we should be really concerned with. I think when we talk about it from a geopolitical front, it's their chips, it's their AI focus that we need to be worried about. And I don't like any deal that kind of buys them time, takes some pressure off of that, and lets them grow. And that, to me, is the risk, because they've got that longer-term horizon than we necessarily do.
Can we talk about timeline for this? What does a longer-term horizon look like?
You know, I think they can think in terms of decades, but to me, and something like AI and chips, this is a 3 to 5 year thing where they're trying to play catch up. They're aggressively doing it. They don't have access to ASML or some of the high technology, but two things are going on. One, they're able to make smaller chips than we would have thought possible. They make them very inefficiently using old machines to make those, but they are getting those. And then the bigger advances that we're starting to see in the chip industry are coming from packaging and how these chips are layered in the semiconductors. And that technology is actually much easier. So China might be able to actually get some pretty good advancements, even while we're trying to restrict it. And on top of that, we're seeing how easy it is to get around restrictions anyways.
Well, and that's actually what I wanted to ask you. What do you make of NVIDIA expanding its staff in China at a time where there are supposedly these restrictions and they're trying to find ways to maintain their presence and their business in the region?
And I think that's going to be a really difficult thing. And I do think companies like that will unfortunately face some pressure from this administration. I think no matter what Trump would like to do from a business side, I'm a complete believer that some high level of national security has this very high on their agenda. It's bipartisan, and no matter what you might think, once you kind of really get read in on what's going on, what the fears are, I think there will be a lot of pushback to, you know, keeping chips and technology out of China. You know, you look at some of these, the Volt Typhoon, all these hacks have been done to impact our infrastructure potentially. This is a real issue, and I think that's going to be a struggle for all the companies trying to figure out what can be sold into China, because it has to be. And quite frankly, I've heard about 80% of the chips we sell into China come back into the U.S. in various products. So it's not an easy answer, but this is tricky. I think we talked about the other day, China is now starting to try and restrict some of the dual-use chips that have been making their way into the Ukrainian drones. This is going to be messy, and I don't see any way around that.
Peter Scheer, wonderful to talk to you as always. Thank you so much for being with us. Peter Scheer of Academy Securities and NVIDIA saying that they're going to keep hiring and that they have hired about 200 people in Beijing to beef up a team of researchers. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. The Wall Street Journal is reporting that Hamas has conceded to two of Israel's key demands for a ceasefire deal in Gaza. The militant group agreed for the first time to allow Israeli forces to remain in Gaza after fighting stops, and also handed over a list of hostages that it would release, including U.S. citizens. Israeli Prime Minister Benjamin Netanyahu acknowledged developments in the talks, but said it was too early to tell whether a deal was within reach. President Joe Biden announcing he is granting clemency to nearly 1,500 Americans. Sentences were commuted for inmates placed on home confinement during the COVID-19 pandemic and who have successfully, quote, successfully reintegrated into their families and communities. The president also pardoning 39 people who were convicted of nonviolent crimes. The move represents the largest single-day grant of clemency in modern history. And FBI Director Christopher Wray announcing he will resign before President-elect Donald Trump takes office. Wray said in a speech to agency staff that he plans to resign at the end of President Joe Biden's term next month. Trump, who appointed Wray back in 2017, made it clear he wouldn't keep him on as director of the FBI, even though he's serving a 10-year term that doesn't end until 2027. Trump plans to nominate Kash Patel as the new director of the agency. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the deficit threat.
I believe the deficit reduction is necessary to keep us on a sustainable fiscal course. There is a threat going forward.
Just a threat that somebody else should deal with, because there's always a sense that it becomes concerning and then you get into office and, you know, one thing leads to another. That's coming up next. This is Bloomberg Surveillance.
politics to the world of business, Joe Matthew and Keely Lyons deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
A little less than an hour until an ECB rate decision as markets in the U.S. take a breather after yesterday's biggest gain, or at least another record high for the NASDAQ 100, led by a couple of stocks. The breadth has really narrowed, and I think that that's important to note. S&P futures off by less than 0.2%. You could see a little bit of dollar weakness, although really it's basically flat on euro dollar at 104.98. 10-year yields, this is what I am watching. 10-year yields now crossing the 430 mark as people look to, if the Fed cuts next week, what does that mean longer term about their ability to cut, given the fact that inflation has been in certain areas pretty sticky? And then, of course, there's the deficit. Under surveillance this morning, the deficit threat.
I believe the deficit reduction is necessary to keep us on a sustainable fiscal course. There is a threat going forward that many of the provisions on the individual tax side, many Republicans have expressed a desire to keep all those provisions in place. CBO said that will cost $5 trillion over 10 years. That would be a blow in the situation.
Here's the latest. Treasury Secretary Janet Yellen sharing her concern over the ballooning deficit, highlighting the potential cost of Trump's previous tax cuts if changes aren't made. Ed Mills of Raymond James writing, on taxes, it is looking increasingly likely that we could see a 4 to 5 year extension versus a 10-year extension. That will keep the cost down and will be easier to pass. Ed joins us now. Ed, it seems like everybody finds fiscal religion as soon as they are on the exit path from any kind of office. How much is there going to be a realization of the deficit by current people who are making a lot of noise around that now, who are going to enter the office early next year?
Yeah, Lisa, something that I've always said is that folks are really concerned about the debt and the deficit until they win the election, because they get in and all of a sudden they want to have other issues and kind of they feel that their team should be the one that wins on policy. And it is pretty rich to have Treasury Secretary Yellen saying that, because you go back and a lot of the fiscal stimulus that has occurred during the Biden administration absolutely was driven by the fact that she was pushing for it. Those Inflation Reduction Act, the American Rescue Plan, kind of pushing Jay Powell on a lot of monetary policy. Those were kind of the economic decisions of the Biden team driven by Secretary Yellen. So her statements there probably gives more boost to Doge versus any sort of conversation related to the extension of the tax cuts.
So you think this just helps the incoming Trump administration for want to potentially find some place to cut some of the spending? When it comes to what we can see, though, at the start of next year, the sequencing of some of these policies under Trump, I'm still trying to understand, Ed, is it going to be 1 or 2 packages when it comes to the border, when it comes to energy, and of course, those tax cuts?
Yeah, Anne-Marie, I think the chair of the House Ways and Means Committee, who's going to be writing this package, wants to know if it's 1 or 2 himself. So I think the Senate preference is to have 2 packages. I think the Speaker of the House's preference is to have 2 packages. But when I look at the House majority, it's going to start off the year 217 to 215. We've talked about, in that scenario, everyone is king. So getting everyone on board to get to 217 is going to be very difficult to get that done once, not to mention getting that done twice. Now, if there are 2 packages, Anne-Marie, that immigration, energy, defense package could see a significant boost to spending in each of those areas. If we're living in a world where instead of significant budget cuts to the Defense Department, we're seeing kind of hundreds of billions of dollars in additional funds to the Defense Department, that's pretty interesting. That's very different than the narrative that's out there. I do think that the most likely thing that we see if we kind of decide one versus two is those tax cuts will get extended. But as I mentioned, to do it for 4 or 5 years, that's under $2 trillion. To do it for the full 10 years, plus the other things that Donald Trump has talked about, that's where it gets north of $5 trillion. I just don't see House Republicans being willing to support anything north of $2 trillion additional debt over the next 10 years in a reconciliation package.
What gets left on the cutting room floor when it comes to those tax cuts? Things like SALT. Does that really happen?
I think something has to happen because when you look at it, Anne-Marie, what I've told folks at Raymond James is there are a good number of Republicans still from New York, New Jersey, Pennsylvania, California, and if everyone's king, there's at least a handful that are not going to vote for something unless something gets expanded on SALT. My base case for SALT is what has been proposed previously, which was increasing that SALT tax limit from $10,000 up to $20,000, but having a tax limit on who gets the advantage. Maybe say only households below $400,000 or $500,000 get that additional $10,000 deduction. That scores at about $130 billion. So it's a lot of money, but it's not in the trillions that if you were to waive SALT altogether.
So putting this all together, whether it's one package or two, it's going to cost a lot of money. What's the offset?
So the offset is going to be, one, they're going to say the tariffs are going to pay for a portion of this. That's the political offset. I am skeptical that things like the Inflation Reduction Act are going to be meaningfully changed because of that narrow vote in the House. I do see some money coming potentially through entitlement reform, particularly on Medicaid. I think there's going to be a conversation about some other sacred cows. Is it going to be about closing a loophole in SALT deductions, closing the tax benefits on municipal bonds, taxing endowments? There's a whole host of things. And so what people have to realize that if you're not at the table here in D.C., you're going to be on the menu. And there's going to be a lot of volatility on those offsets. But I don't think you're going to need much more than $500 billion or $1 trillion worth of offsets. It's not the $3 to $5 trillion worth of offsets that people thought you would have. So maybe the pain will be a little bit less than feared.
And speaking of trying to be at the table, we certainly see a lot of tech executives trying to do just that. We learned overnight that Meta donated $1 million to Trump's inauguration fund after not doing that for Biden or Trump's first term. At the same time, we have someone like Andrew Ferguson going to head up the FTC, who has been critical of some of these big tech companies. Ed, put all the pieces together. What do you expect policy to look like in enforcement to some of these big tech companies?
Yeah, so that $1 million donation by Mark Zuckerberg and Meta, that's being at the table. That's a recognition that if you were to continue down the path that policy has been, it's going to be another tough 4 years for big tech. Is there a way to change that conversation? I do think when I look at the elevation of Ferguson to FTC chair, Gail Slater at the Antitrust Division of the Department of Justice. These are folks that are going to continue a lot of the antitrust push that we've seen over the last 4 and 8 years. But there is going to be a subtle shift. Over the last 4 years, we've been focused more on the size and bigness of the companies. We've been focused on workforce issues. I think these are individuals that are probably going to go back somewhat towards a consumer welfare standard. Applying a consumer welfare standard to big tech deals is something that was favorable to big tech for a number of years before the move towards populism has come over. How long that lasts or kind of can they get a settlement out of some of the pending litigations? Those are the big questions that I've been getting at Raymond James.
Just real quick, is buying Tesla a policy trade right now?
It seems to be. Elon Musk has kind of done quite well. You know, the run up in Tesla and the fact that you have Elon Musk at the head of a lot of these regulatory changes, potentially being a part of the conversation with China, he's positioned himself well. The question that I get is how long is his shelf life with Donald Trump and who decides that this relationship is over first? It just might be this is so valuable to Musk, he wants to keep it going as long as possible.
And is there someone else in the running to be first buddy? Ed Mills of Raymond James, thank you so much. It seems as though maybe Mark Zuckerberg wants to put his name in the hat for first buddy should the relationship fall apart.
We've seen a few of those olive branches from Zuckerberg. When Donald Trump got shot, he said that was the most badass thing he'd ever seen, and he came up from that. Also, he went and had dinner with him ahead of Thanksgiving, and now he's throwing some money at the inauguration committee.
Yeah, Danny, you make a great point. I mean, honestly, how much you're going to have to see this in order for them to avoid the antitrust?
Yeah, especially with Andrew Ferguson coming in.
Yeah, and the rhetoric talking about trying to enforce that. Coming up next, we're going to talk about the consumer. Holly O'Neill of Bank of America on the outlook for consumer banking in 2025. Just how much firepower do they have left in their bank account? Cheat sheet, quite a lot. This is Bloomberg Surveillance.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
About 45 minutes until an ECB rate decision. The expectation widely is a 25 basis point rate cut. Yesterday, U.S. equities hitting an all-time high, at least in the tech sector, not necessarily the S&P today, taking a little bit of it back. 2 hours away from the cash open, here are your morning movers with Manus Cranny. Manus, good morning.
Hey, Lisa, very good morning to you. Adobe, they've got the software for creators, and they're trying to monetize that more aggressively. And this is where the disappointment comes in this stock. Not only did they guide lighter on the year in terms of revenue at $23.4 billion, It's a wonderful acronym, DMRR, Digital Media Annualized Recurring Revenue, a mouthful. But the point is, they say that's going to grow by 11% as opposed to what you had this year, which was at 13%. So you can try and monetize your AI, you can try and upsell your AI. It's about how much are you prepared to pay as a customer for the additional functionality of AI, that tiered subscription. So this is disappointment all the way around there. Uber, the CFO was on the stage yesterday at a Barclays conference, full boat. Still year-on-year growth for them in San Francisco above the US average, and what you've got is tourism. That's autonomous vehicle experimentation tourism going on in San Francisco, which is a nice way to put it. TD Cowen say they're positive, the strategy after the CFO meeting with them. You just talked about NVIDIA. Why are they deploying 200 new people in autonomous vehicles in China? What's Elon going to have to say about that to the president-elect? I'll leave you with a snapshot. It's another upgrade. Constellation Energy, Bank of America. Price target here, $269. Sustained double-digit growth. Compelling valuation relative to their peers and in the best position to prosper. It's a bit like the whole team out there. Lisa, good morning.
Good morning, Menace. Thank you so much. We're under surveillance this morning. Sources telling us here at Bloomberg that President-elect Donald Trump is scheduled to ring the opening bell at the New York Stock Exchange this morning. Trump, during his first term, often tied the stock market's performance to his economic policy, which raises the question, Anne-Marie, of how much he will do the same this time around.
Exactly. Is there going to be, as what Brian Levitt talked earlier today, and Jonathan always talks about, this Trump put, this idea that this could be a check on some of the incoming president's policy proposals. What we saw, the first iteration of Trump, some stuff would leak out to the press about maybe pulling out of a trade deal, stocks would go lower, and then there would be maybe a phone call between him and President Xi Jinping, or potentially there'd be someone else coming out and saying, actually, we're not thinking about doing that, we're just thinking about getting a better deal. So it's all about the stock market, and I think he's just gonna walk in and say, look, my Trump trade, how much richer are all of you because of that?
It's so fitting, right? Like, it is so fitting at the end of 2024, in the middle of this rally, to have Trump. I want to know who's going to be with him, though. I feel like this is going to be another, like, airplane photo op moment to be like, oh, Elon Musk is standing in the background. Who's there? Who's not there?
Well, and who might be positioned where might determine their wealth. Elon Musk becoming the first person to reach $400 billion in net worth. The move spurred by a recent insider share sale of his privately owned SpaceX. That alone boosting his net worth by roughly $50 billion. Danny, raising a question of what the value of having a closer seat to the president really is.
And we see tech companies grappling with this, with Meta donating $1 million to Trump's inaugural fund. I was just looking at the numbers. Every single day since the election, given he's worth over $400 billion now, that means he added $7 billion a day. You could argue that that is the worth of being so closely connected to Trump, because it is Tesla, it is SpaceX, it is all of his companies. It is a really valuable thing, but as Ed Mills was just saying, it's only as valuable as that good fortune lasts.
Right, so the concern is for people who maybe, like Dan Ives, who are putting all this money into and all this hype and optimism into Elon Musk's companies, is what happens if that relationship were to falter. But other executives are taking notice. Look at this from Axios, sitting down with Mary Barra, the GM CEO. She said that federal regulatory framework for self-driving cars, which Elon Musk has been suggesting to President-elect Trump, would be better than state-by-state patchwork. And then she goes on to say, I think there's a lot we have in common. Her and Donald Trump. This was someone who worked so closely with the Biden administration. So the tide is changing, and you see executive after executive in the tech space, auto space now, lining up to try to get a seat at the table.
GM making some other moves as well. Microsoft expecting to take an $800 million charge as GM announces the terminations of its autonomous taxi initiative, Cruise. The automaker citing the high cost of tech development and building out a fleet of vehicles. Microsoft had announced a minority investment in Cruise in January 2021 that was part of a $2 billion investment round. It feels like, Danny, people are assessing what their investments are in tech, which are paying off, and cutting the cord if they're not.
Because so many people had seen the future to be autonomous vehicles. It feels like maybe a bubble is too strong of a word, but something that popped. Maybe popped enthusiasm. I mean, Apple is another case here. They plowed so much money into driverless technology, and they had to completely reverse course too. I was looking at some of the calls. Basically in 2017, every single car and technology company was saying that this was the future, that by the 2020s, we'd have autonomous vehicles on the road everywhere. Uber was saying by 2020, they'd have a taxi service that was a helicopter. I mean, people really got over their skis and spent a lot of money, and now we're taking losses on some of that.
All I can say is I hope that they come up with a taxi service. It's a helicopter, but let's move on. It really does all come down to the consumer and what the appetite there is. We want to really focus on the U.S. consumer. Bank of America releasing its final consumer checkpoint report of the year, saying there were no signs of consumer resilience waning in November. President of Retail Banking Holly O'Neill writing, spending momentum carried across all income cohorts through the gap between higher, middle, and lower income household. Spending growth is narrowing. Holly joins us now. Holly, wonderful to see you. Thank you for being with us. Good
morning.
Good morning. How much power is there left in bank accounts, in desire, in some of the spending trends that you're seeing right now?
Well, as you said, the consumer resilience is not waning. So across all of the metrics that we look at, they look really healthy. And the dry powder is there. So when you look at the money they have in their checking and savings accounts, it's still significantly higher than it was even pre-pandemic. Now, we've seen that come down, but it's still higher. So they still have some cushion in there across all income cohorts, high, middle, low. And in particular, the low income cohorts look even stronger when you look at it on a percentage basis. So from a liquidity perspective, they look strong. From a borrowing perspective, they also look strong. So they're borrowing in and around the same levels that they were pre-pandemic. When you look at our credit card data, so that looks good. They still have borrowing capacity. The credit environment from a bank perspective is fairly normalized. So I think the resilience of the consumer looks strong. And their spending also looks good. And we're obviously in the peak spending period of the year. So their spending looks good. Their spending was up in November. And that matches our data of our surveys that we take pre-holiday. What are you expecting to spend during the holidays? So
well, the reason why I find this so interesting, first of all, is because this has been what has driven U.S. exceptionalism and is the envy of a lot of other countries, but also runs counter to what we're hearing from the guidance of certain retail companies in particular. How do you square that?
Well, I think that the consumer, you do have difference in sentiment versus actual behavior. So we look at the actual behavior of the consumer. What are they spending? What are they spending on? So as I said, spending is up. Holiday period, it's also up. They're expecting to spend $2,100 this holiday period. That's up 7%. So, you know, within that, we're seeing trades to more discount stores. So they're looking to stretch their dollar a little bit more. And they're seeing the benefit of some lowering prices. So in gas, as an example. So in gas, we're seeing a higher number of transactions, but the dollar amount is lower because the prices have come down. So they're making trades within their spending behavior, and they're really making their dollar go further.
How do you distinguish the sort of trading down whole scenario? How do you say that's stretching the dollar versus this is weakness and this is something that might show some cracks?
I think in my opinion, it's the consumer making good choices with the money they have to spend. They're very informed because the overall spending number is higher year over year. But then within that, they're making trades and adjustments. At the same time, their liquidity levels are still strong, and they still have borrowing capacity. So all of those things working together, I think, are showing a good, strong, resilient consumer.
The trend has also been this spend on services, airline spending still robust, cruises still robust. Do you see that continuing on, or could we have any sort of rotation back into good spending?
I think you could see that rotation. As you all know, during the pandemic, people really upped the ante on the durable goods, the washers, the dryers. We still haven't seen that come back because those have a long shelf life. So I think as you see that mature, you could see it shift back. But the spending patterns really remain fairly consistent. Travel, experiences, services, those are very strong. We are seeing in this holiday spend, we are seeing electronics come back a little bit. So that's also, you know, a beginning trend, I would say.
Speaking of the holiday season, a lot of retail analysts have come on and said they're really focused on the fact that there's 5 less shopping days because it's a shrunk, basically, holiday season between Thanksgiving and Christmas. Do you see that having any impact at all on consumers willing to spend?
No. I think overall the consumer is going to spend for the holidays. You know, it is a more truncated period, but we adjust for that when we look at the behaviors. So for the 2 weeks around Thanksgiving, and it was late this year, right? I think it's as late as it can get. We did see that spend go up. And so I think it's just going to be a more truncated period.
What would you be looking for if you see any cracks of this resilience?
I would look to their spending patterns first. Again, borrowing, we will always look at as a bank, but the borrowing behaviors are still really strong. They're still paying credit cards off at a pace that's faster than it was pre-pandemic. That's a really good sign. And then the liquidity in their checking and their savings accounts. And, you know, I think we've seen that really kind of flatten a little bit. And as we get into 2025, I would expect to see that start to grow again.
I'm trying to build on what Amaru is talking about. There seems to be a disconnect, and please help us with this. Because on one hand, in this survey, you talk about the gap between the wealthiest and lower income cohorts narrowing actually marginally. You talk about a robust firepower in their bank accounts. You talk about ability and willingness to borrow. And then you talk about looking to stretch their dollar. This kind of behavior that you typically see on the brink of something that does feel like, to Danny's point, a weakening. So what gives? Why aren't people spending more in a traditional and freewheeling way when the data seems to suggest they'd be in a position to do so?
I think that we've seen a permanent shift in what the consumer wants as a liquidity position in their account, right? So I think they got used to that during the pandemic, saying, I have more cushion in my bank account and I'm going to keep that there. And then they're making the trades into lower cost goods to make sure they keep that and maintain that level. So, you know, I think that's one of the trends. But I think it's the consumer who is very educated, very aware. There are deals everywhere. They're in social media. We know that 30% of our clients are planning to buy in social media this year, which is very interesting. And so I think they're very aware and very informed and making choices.
Is that the same thing as price fatigue? Because we've heard that a lot among companies, that, you know, their margins, they can't keep expanding it because there's fears that people aren't willing to pay up. Is that the same, a different side of the same coin?
I think it could be, yes. And I think, you know, it's consumers, again, making very informed choices and taking control for themselves as to where they can spend their money, where they can budget.
Holly O'Neill of Bank of America, thank you. This was really, really interesting. Holly O'Neill there with us at a time. 30% are going to buy on social media. Danny, that was actually pretty stunning to me.
It's huge, and it also speaks to why companies like Macy's are struggling, because fashion trends are happening so quickly now that they're happening on social media. And if you're a company and you haven't kept up with that, you haven't adapted your brand, you're going to struggle because people demand something very specific now.
I only have done that once, social media buying, and to be honest, I really didn't like what came through, and now I never do it.
Yeah, well, I don't think that we're the target demographic from the experience I've seen in my household with some of the younger folk. Right now, let's get to an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. South Korea's opposition has filed a second impeachment motion against President Yoon Suk-yeol. The motion was filed after Yoon made a defiant speech in which he tried to justify his martial law declaration last week, insisting he would fight any case against him. If the motion is successful, a court ruling will determine whether Yoon will be forced out of office. That would lead to a presidential election being called within 2 months. Now the latest on the investigation into United Healthcare CEO Brian Thompson's murder. New York Police Commissioner Jessica Tisch said the 3D printed gun that Luigi Mangione had when he was arrested this week matches 3 shell casings found at the crime scene. She also said a crime lab was able to match the person of interest fingerprints with those found on both the water bottle and the kind snack bar found near the scene. Mangione remains in custody in Pennsylvania. And Meta donated $1 million to President-elect Donald Trump's inaugural fund. This part of an effort for the tech giant to build a positive relationship with the administration. Meta owns Facebook and Instagram, both platforms Trump was suspended from after the January 6th insurrection, though Trump's accounts were reinstated in 2023. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira, and I just got schooled. It's not an age thing. It's just a coolness thing, I guess. Up next, the Fed's Balancing Act.
Right now, I'd say the inflation story is still benign. When the Federal Reserve looks at it, they're going to have to look with one eye on what's really going on in the economy right now and one eye on what might be coming in terms of policy.
That's coming up next. This is Bloomberg Surveillance.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Less than a half an hour until the ECB rate decision, and then 15 minutes after that, we get PPI for components that are going to be put into PCE, the alphabet soup of inflation that we talk about, and of course, initial jobless claims. Key question will be, how much do people feel like longer-term yields are going to stay at these levels? Under surveillance this morning, the Fed's balancing act.
Right now, I'd say the inflation story is still benign. It's cooling very slowly, but it's still cooling. But the question is, what are we going to do to that when we attack this with policy changes next year? When the Federal Reserve looks at it, they're going to have to look with one eye on what's really going on in the economy right now and one eye on what might be coming in terms of policy. This is a really good economy for financial markets. The question is, can we sustain it in 2025?
Here's the latest. Traders expecting the FOMC to cut rates at their meeting next Wednesday, but a slew of unknowns weighing on the outlook for growth and policy in 2025. Michael Collins of PGIM writing, economic growth in the U.S. remains outright strong, but we still believe growth will moderate due to most consumers running out of discretionary income. Interest rates will remain restrictive, and much of the rest of the world is struggling. Michael joins us right now. Mike, thank you so much for being with us, and welcome. I've been trying to make something of this, and everyone's been shutting me down, but I want to get your take on this. Yesterday, I thought the price action was really interesting in bonds. We had a rally when we first got CPI bang in line with expectations, and then a sell-off in the long end as people started to worry about next year. Did you take any signal from that?
I think the markets are confused, just as the Fed is, about the data. You know, as Mr. Kelly just said, I mean, they're looking at the current environment, which is really strong, right? I mean, if you look at all the GDP expectations, we're kind of poking toward 3% here on a pretty consistent basis, Lisa, right? And inflation obviously has kind of been running a little higher than the Fed's 2% target. So, I mean, you know, all else being equal, the rate today at 4.30 feels like it's fair value for the current environment. But remember, the Fed and the markets are supposed to be forward-looking. So what is the world going to look like in terms of growth, in terms of inflation, in terms of the fair value of interest rates in a year and 2 years from now? And that's where, again, I disagree that the current environment isn't really sustainable and that eventually the rate structure will be lower. But for now, it's hard to argue with rates at these levels.
What gives you confidence about that, Mike? And I would just follow on, how much conviction do you have on this to be buying with both fists at a time where everyone else is saying, oh, we could see 5% again?
Yeah, I mean, I just don't think that is sustainable. That level of interest rates, as you just saw in that summary, Lisa, is just too restrictive. And the Fed gets that, right? They understand that rates are really restrictive now, that a real rate, I mean, the real funds rate, you could argue, is, you know, probably 2% right now, which is, you know, 150 basis points above where the Fed has previously said the fair value real rate that our star is. So they're very restrictive now, and it is biting, right? It's biting consumers, and you're talking about consumers trading down in your last segment, and that is happening in a big way. Our retail analysts are seeing it. I mean, 2/3 of all the sales growth in retail sales right now are coming from Amazon, Costco, and Walmart. I mean, if that's not telling you what consumers are doing with their pocketbooks, I mean, that's a real strong signal, I think, of the pressure, the pushback on this high level of prices. So,
Mike, if I can just jump in on that point exactly, because Lisa and I both asked Holly O'Neill of Bank of America about that and said, how for you is that not sign of cracks? And she said, because the overall spend is higher. It's just consumers that want a liquidity buffer in their bank account. It's not weak consumers because they're spending more, delinquencies are falling, and the spending gap between high and lower income consumers is actually shrinking, and they look incredibly healthy. What do you say to that kind of data?
Yeah, I mean, the wealth effect has definitely helped, and it's not just housing and the stock market, but, you know, increasingly younger people have owned things like Bitcoin and other cryptos, which makes them feel wealthier. But I think it's a big difference. There's a big difference between the average household, which is generally what the economic data portray, versus the median household. And I really believe, Danny, that there's this huge cohort, maybe 80% of the consumers in this country that are really struggling. I mean, I have, you know, 3 kids in their 20s, and I think their average bank account has $0 in it, right? And I don't think that that's not representative of the broader economy of young people who've really been hit hard by higher rents, higher insurance, higher food prices, you know, higher auto prices, you name it. It's brutal. And I think all of those things are going to bite. They haven't yet, but I think over time that those higher rates start to bite, and I think the Fed will have to capitulate at some point. And I don't think it's going to be next week's meeting. In fact, I think those dots will probably come up in terms of the amount of rate cuts the Fed expects for next year and maybe even into 2026. But I think ultimately the average funds rate over the next 10 years is probably going to be a lot lower than what's priced in today.
Sounds like a difficult time to be Bank of Dad at this very moment, Mike, so my sympathies go out to you. But there is this feeling right now that the animal spirits have been reawakened and that there's positivity among companies, that they want to do more CapEx, that M&A, a wave is coming back and deals are going to be flourishing in 2025, that something's going to be happening and something will be in the water that reignites inflation, whether it be that or whether it be policy linked to tariffs and linked to tax cuts. Could that possibly outweigh some of the fears that you're speaking of?
Yeah, that's all possible for sure, Danny. And in the near term, that's what's being priced in, right? In the near term, the markets are pricing in a continuation of this really strong economic growth outlook, or a continuation of the sticky inflation, a continuation of these restrictive or really high interest rates. That's what's priced in right now. The markets are pricing in a funds rate that gets down to 3 5/8 and stays there forever, right? Could that happen? Absolutely. Could that be the environment we remain in for the next 12 months? Absolutely. But as long-term bond investors, on behalf of our clients, Danny, we're looking at, the 10-year yield at 4.30 today, and that's supposed to be the average of the funds rate plus some term premium over 10 years, not over 1 year or 2 years, right? So we're always trying to take a long-term perspective on maybe which way the market's leaning and whether that's right or wrong. And right now they're leaning to this real persistence, this extrapolation of the current environment continuing to be really robust, and that's where I have my doubts.
Mike, we just have about 30 seconds. Are you basically buying long-term treasuries and selling lower risk credit?
Absolutely. That's the trade, right? You add duration on backups here. We've been pretty consistent probably for the last 12 months on this, Lisa, as the rates back up toward what I think the high end of the range is, which is closer to 4.5. I get excited. Our clients get excited, and we're certainly advising them to add duration at those levels. And as spreads keep ratcheting tighter, even though you will have credit risk increasing across the macro climate, you're supposed to cut credit risk, right? So those are the big two themes that we're certainly instilling in our portfolios.
Mike Collins of PGIM, thank you so much for being with us. It's always illuminating. Coming up next hour, Anastasia Amoroso of iCapital, Sam Zeef of JP Morgan Private Bank, Dana Peterson of the Conference Board, and Scott Kroner of Citigroup. You're watching Bloomberg Surveillance.
2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
its own bank,
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
The inflation story is still benign. It's cooling very slowly, but it's still cooling.
We're basically now living in a 2% inflation world rather than a 3% inflation world.
You're still running at 3.25%. That's still well above where the FOMC wants to see it.
Consensus is that we are on a downward inflation trend. The Fed does not seem worried about inflation being a little sticky above target.
For the moment, U.S. exceptionalism is a story that's really, really hard to push back on.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. 90 minutes to the start of the trading day in New York, and all eyes turning to Europe. ECB rate decision coming up in 15 minutes with the broad expectation of a 25 basis point rate cut following significant rate cuts from the Swiss National Bank and the Bank of Canada. Markets pulling back a little bit after yesterday's gains, snapping a two-day losing streak. And yesterday we saw the outperformance in big tech. Today we are taking it back. NASDAQ 100 futures down, leading the declines lower, down 0.4%. Really, the key is going to be, Danny, how much can other central banks outside of the U.S. front load some of those rate cuts to get ahead of the uncertainty of 2025?
It does seem like there's a desire at this moment to decouple from the Fed. We're talking with Peter Scheer about this, that on the way up, you saw different central banks wanting to stay in tune with the Fed because they didn't want to let their currency weaken. They needed a stronger currency in order to battle inflation. It's completely the opposite this time. The S&P is explicitly saying that they're cutting 50 basis points in order to weaken the Swiss franc. Are you going to see something similar from the ECB, that they want to get out ahead of not just the Fed, but of incoming President Donald Trump?
And this is the first decision as president of the S&P, and not only cutting rates, but saying potentially we could go negative if we have to, because negative rates do work. All of this a reaction ahead of potentially, to Danny's point, what comes down next year? The rhetoric coming out of the Trump administration, a more protectionist America. S&P, ECB, they're going to have to find a way out of it.
Which raises the question of how much is this time going to be different than 2016, given the fact that you have companies and countries trying to get out ahead, with the reactions coming before even President-elect Donald Trump takes office, Danny?
Yeah, I mean, they have learned the lessons of 2016, of 2017, and thereon. They learned that it can be useful to be transactional, not only as a country, but as a company, too, that if you want to escape the broad wrath of tariffs, you need to be someone like Tim Cook, who goes and meets with Trump and tells him how horrible it is to have tariffs on iPhones coming out of China. That maybe is the only way to escape, and they learned that lesson.
And we're going to be closing out this year and starting another year where we're going to talk all about all of those maneuvers. Coming up this hour, Anastasia Amoroso of iCapital. Is stock snap a two-day losing streak? Sam Zeef of JP Morgan Private Bank on the Fed versus ECB and the divergence we're seeing there, as well as Dana Peterson of the Conference Board reacting to PPI and, of course, initial jobless claims. We begin this hour with stocks steady, the NASDAQ hitting a fresh record high. Investors digesting an inline CPI print, all but guaranteeing a Fed rate cut. Anastasia Amoroso of iCapital saying even if the Fed slows or stops their pace of cuts in 2025, there should be 100 basis points of relief by this December from the 5.5% level seen earlier this year. That is already meaningful. Another 50 basis points, the current market expectation, would help more. This should support growth, stay with the positive momentum for equities. Anastasia joins us now. Anastasia, wonderful to see you. Thank you for being with us. Good morning. I'm just wondering how much these rate cuts are supportive at a time where maybe rates are not as restrictive as some people think.
That's right. Well, they are certainly working their way through the economy in terms of the rate cuts. And when we came into this year, we wrote about the sizing of the U.S. debt piles in the corporate market and consumer market and the U.S. government. And we thought we were thinking about these floating rate exposures that were a concern. But the opposite of that is happening today. And what I mean by that, private credit, for example, if you're a private credit borrower, if you're a leveraged loan borrower, you are paying an exorbitantly high interest rate. And you are starting to see some relief because those coupons are resetting lower as we speak. If you're a consumer that may be carrying a floating rate balance in your credit card, you're also starting to see some pullback there as well. And so the more this happens, the more months occur, the more relief actually accrues to the U.S. consumer, the corporate, and also the real estate operators. And that's just to start. If we do have another 50 basis points next year, the rate relief is that much more.
Especially at a time where the rate cuts elsewhere are so significant. We're about 10 minutes out from an ECB rate decision. The expectation is a 25 basis point rate cut. I just wonder how much the fact that international capital has been piling into the United States also, seeking yield, seeking economic growth, how much that turbocharges the trends you're talking about.
I mean, it certainly does help. And look, the 10-year Treasury yields have been incredibly sticky, partially because of strong growth in the United States, partially because of the concern about the budget deficits, and I think partially because the economies elsewhere are fairly weak and rates are being cut. So I think that will send flows back into the United States. By the way, next year, we were talking about this, is likely the year of protectionism. It is likely the year of America First policy. So I think that, too, Lisa, is going to send flows to the United States, or at least keep them coming here.
If you would have told someone that we'd get that America First policy, that by the end of 2024, we'd have 75 and now 100 basis points of cut with December, once we get that, you would have said, okay, it's going to be a huge month for small caps. Small caps will be off like a rocket. You saw that in the beginning post-election. But since then, the rally has really started to concentrate again. It's been the Mag 7. It's been the tech players. Breadth has been negative over the past 8 trading days. Is this a sign that the small cap trade might not play out as expected in 2025?
No, I don't think so. I think what's really happening is that investors are being very active in terms of their exposures, and there's definitely some trading that's starting to take place right now, and they're chasing the near-term laggards, and they're selling some of the near-term winners. And I think that's what happened after the election. You've seen this great month for small caps. You've seen a great month for regional banks and financials, and then you took a pause with that, and you looked to big tech, for example, and the fact that it's lagged, the semiconductors, software, and all of that right now is having a catch-up moment. So I think it's about a series of those rotations. But no, I don't think investors have given up on the fact that it's going to be domestic economy first in 2025, domestic revenues first. But I would probably broaden out the small cap trade and just say prioritize companies that have a high share of domestic revenues, whether they're small, medium, or large. And if we are going to end up with an environment, I call plenty of wildcards in 2025, that we talk about tariffs before we talk about tax cuts, that probably does have a few risk-off moments. So maybe small caps is not the only place you want to be. You want to be in a high share of domestic revenue companies that maybe have the quality tilt to them as well.
If you're worried about tariffs and domestic policy, is it useful to stock pick depending on what CEO is reaching out to Donald Trump, depending on who's down at Mar-a-Lago?
Well, that might be a factor, yes. So some managers will choose to incorporate into their models. But I do think next year is all about the dispersion of sectors, factors in different stocks. And, I think you want to be positioned in parts of the economy that are growing and also have a high share of domestic revenues. Obviously, engagement with the administration is also a good thing. So that's why we're looking at financials, we're looking at regionals, we're looking at utilities. We're also looking at software stocks, for example, relative to the semiconductor stocks. And, speaking of, chasing laggards, right? Semiconductors have had a stellar year in 2024 and also 2023, but I think some rotation into the domestically tilted software makes a lot of sense now.
Well, building on Danny's point, I guess the question is, do you expect this administration to do what they've done in the prior when they were in power, which was for some companies, you're going to have to offer carve-outs?
Yeah, I think it's definitely a possibility. And, Anne-Marie, I would say, the title of our outlook for next year is Solid Underpinnings for the U.S. Economy and Plenty of Wild Cards. And the truth is, we just don't know which wild cards we're going to get. And the wild cards that I'm thinking about are tariffs and taxes and budget deficits, as well as the direction of Fed policy and also the direction of big tech regulation. And the truth is, we might get an administration that imposes the unilateral universal tariff, or maybe they have a threat of it, or maybe there's an agreement that actually gets negotiated in the process of it and does it very quickly. We don't actually know what the ultimate outcome is going to be. And so that's why for investors, I think it's really important to stay pro-risk, to stay pro-growth, to stay pro, solid economic environment, but just recognize that the range of outcomes is going to be wider.
Anastasia Amoroso, happy holidays. I think
Happy
we can say at this point.
Lisa.
Thank you so much for being with us. We really appreciate it. As we count you down to an ECB rate decision followed by PPI and initial jobless claims. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. President-elect Donald Trump tapped Carrie Lake, a former TV anchor, to be the next director of the federally funded broadcaster Voice of America. Lake, an ardent Trump champion, ran unsuccessful Senate and gubernatorial campaigns in Arizona. Voice of America provides news in more than 40 languages to audiences around the world. Meanwhile, Bank of America promoted 387 employees to managing director, 16% more than last year's total. The promotions are according to people familiar with the moves. More than half of those elevated to the senior role were women or people of color, marking the 5th year in a row that historically underrepresented groups made up the majority of the class. And former New England Patriots coach Bill Belichick is moving to college football. The Athletic reporting that Belichick and the University of North Carolina have agreed on a deal worth $50 million over 5 years. The deal makes the 72-year-old one of the highest paid coaches in the college game. In Belichick's 24-year tenure at the Patriots, he won 333 games and 6 Super Bowls. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. I think we're going to leave that story right there. Up next, the ECB rate decision. We'll have the details and get the reaction from Sam Zeef of JP Morgan Private Bank. That's next. This is Bloomberg Surveillance.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
more than a minute ahead of that ECB rate decision. The broad expectation is for 25 basis points of cuts, with possibly a dovish inclination as to moves coming out next year. Right now, state of play in the U.S., what you can see is a sell-off building in the NASDAQ 100 futures, down about 0.4% in the yield space. And this is actually pretty interesting. In the U.S., you're seeing things inflect higher. In Europe, it's actually significantly lower as we look to potentially lower rates by the ECB. The Swiss National Bank coming out earlier this morning, and Danny, not only cutting by a half a percentage point, but also with the new head of the S&B saying, actually, negative rates, no one likes them, but they work.
If your rate right now is at 0.5%, and you need more firepower, not just for now, for the economic weakness coming from a weaker currency and a weaker general environment, but for what might happen in 2025. They want to make sure they have the ability to grapple with whatever comes, be it tariffs or just further political and economic weakness in the region.
Which is the reason why I'm curious to see what the rhetoric is. ECB decision, I expected the headline, but with respect to the future guidance, very curious to see how much they signal and a willingness to allow some sort of a negative rate policy. We are still waiting for those headlines. The expectation is for a 25 basis point rate cut, and you get that 25 basis point rate cut to 3%. That was the broadly expected estimate. They're not pre-committing to a particular rate path. They're expecting to lower the three key ECB interest rates by 25 basis points. I'm curious to see what the breakdown is going to be. This is the key. They are determined to ensure that inflation stabilizes sustainably at its 2% medium target for inflation in the region. Key question is, how much are they going to counter weakness? They do see 2025 inflation at 2.1%. The prior expectation was 2.2%. And 2026 inflation, they're keeping at about 1.9%. Anything standing out to you, Danny, that really gets your attention in any of these headlines?
Well, it's just, you know, an ECB that has a single mandate, that cares about inflation. And again, these lines really just go to speak to that, saying that they're determined to get inflation stabilizing sustainably at 2%. The fact that they didn't change their outlook for 2026 inflation. Nowhere, at least on these headlines so far, do you see an ECB that's ready to really pump up the firepower and get cuts in there and to really support the economy at this point?
Lizzie Burden right now joining us from Frankfurt of Bloomberg. Lizzie, so good to see you. What do you notice from some of the commentary and the breakdown of the vote?
Well, look, we were expecting this quarter-point cut from the ECB to 3%. The hawks weren't going to be backing a 50 basis point move when you had this rise in negotiated wages in the third quarter. It isn't that long until the next ECB meeting, when, of course, Donald Trump will be back in the White House, and there should be a bit more clarity on the tariff threat. Of course, the euro area very much in the firing line. So the focus was always going to be on the path ahead here. What's interesting is you've got the updated forecasts, as you say, and a slight downgrade to inflation this year. They had seen 2.5%. Now they see, they have downgraded the inflation forecast slightly. And indeed, at the last press conference, Christine Lagarde had said that the inflation risks were tilted to the downside. So this revision, not a surprise. We'll also be looking ahead to the press conference. I am sure that Lagarde is going to be asked, as a French woman in Germany, about the political hurdles, shall we put it mildly, in France and Germany, and the impact of the fiscal tightening potentially on the ECB. If there's less fiscal tightening, does the ECB have to do more work? I'm sure that she'll be asked whether 50 basis points was on the table at this meeting, and also about the neutral rate, because there's surprising alignment between the hawks and the doves on the Governing Council about the need to get to neutral. The question is where neutral lies.
And Lizzie, you are seeing a reaction. The euro is weakening 0.2%. This also just crossing that the ECB has dropped their reference to restrictive from their statement. How much of this might be a win for the doves, that the balance of power maybe is shifting to them, Lizzie?
This is a dovish tilt, Danny, and it's what we expected as well. Previously, the language had said that they were going to keep rates sufficiently restrictive for as long as necessary, and therefore it is a dovish tilt that they have changed that language here. It is what we expected, given that the picture had darkened, both in terms of inflation and growth, since the last meeting, not least because of the political collapsed governments in France and Germany, but also with the return of Donald Trump to the White House and the continued problems, the economic weakness in Germany, the second straight year of contraction there, and the wars in Ukraine and the Middle East as well.
Lizzie Burden, great work as always. Thank you so much for being with us. That's Lizzie Burden of Bloomberg. Joining us now from JP Morgan Private Bank is Sam Zeef, as he sits here and watches all of these headlines cross. Sam, what's your impression?
I think you guys have really nailed it. All of these central banks, between the Fed, the S&B, and the ECB now, are trying to ensure that inflation stabilizes at 2%. But how they're going about it is completely different. The Fed is thinking about how do they inch down towards neutral, keeping policy restrictive enough because the economy is in a really good place and they don't want inflation to reaccelerate. Where I would argue that the S&B and now the ECB, with the drop of restrictive in the terminology, is actually just arguing, well, how far below neutral might we need to go to ensure that inflation stabilizes at 2%? And that divergence between what we're seeing with these major European central banks and the Fed is really what underpins our view in FX that the dollar is going to be strong, particularly against these types of currencies.
Does it go far enough? Because Robin Brooks of the Brookings Institute has been arguing that Europe desperately needs a weaker euro, that you're not going to get instituted anything that Draghi outlined of Europe coming together and spending more. The budget standoff in France shows that they have very little fiscal room, and because of that, they should be decoupling from the Fed at this moment and be doing larger cuts. Yep. Do you think there's any credence to that argument?
Yeah, I mean, whether it's because I don't know if a weaker euro is going to actually spur innovation and investment, which is what that Draghi report made, but clearly the economic trajectories are very different. The Fed's or the US's is arguably tilted to the upside. The economy is in a really strong place. European economic outlook is definitely tilted to the downside when it comes to growth. I don't think the euro is the main policy tool there. I think it's interest rates. But there's room to lower interest rates. There's room to move further into accommodative territory. That's going to be the ECB's priority. The euro is the knock-on effect, and it's going to end up in a weaker euro. But really, it's going to be the rate channel that they focus on.
We do see the euro dropping after this decision below 1.05 against the dollar. Do you see parity next year, given the fact that it's a weaker growth environment in Europe, and on top of that, they're dealing with a Donald Trump administration?
We definitely wouldn't rule it out. In the private bank, the lower end of our kind of euro range that we're looking at in 2025 is 102. But, as an FX strategist, I know the difference between 102 and parity is, going to a few days, let's say, of trading. So a test of parity is definitely something that we're not ruling out. And definitely one of our high conviction views that we're talking about with our private bank clients is being underweight European assets, favoring the dollar, being short euros, funding in euros, all of these things that benefit from the same thing.
Given the political paralysis we're seeing in France and Germany, given the fact that they are dealing with a tougher environment in terms of potential trade wars in 2025, the ECB is saying they're going to follow data-dependent meeting-by-meeting approach. Is that correct? Or do you think Lagarde, when she comes out and gives her rhetoric and answers questions, she's going to tilt more to the dovish side?
I think the most interesting thing from the press conference that I'm going to be watching is, so they've gone by 25 basis points today, but the market is still pricing in about a 30-40% probability of a 50 basis point move at some point, either in January or in March. Whether that there's some nod to the fact that that could be on the cards, they've so far been fairly, let's say, cautious in guiding against a 50 basis point move. But I think because that market pricing is there, it's going to be really important to watch whether they endorse that type of probability or possibility. And then that's going to be how I take up the press conference, to be whether they're moving in a more dovish direction or not.
Should we be talking about negative rates again, like the S&B is?
So I would say that what they said, just to be clear, is that, as you said, no one likes them, but they're there and they work, particularly for a country that is really using, let's say, the currency as their main tool for monetary policy. I don't think that the S&B is going to go back into negative rates unless the ECB kind of forces them, right? Think about when they went into negative rates last time. It's when the ECB went negative, the S&B felt like they needed to respond. I think that would take not just economic weakness in Europe to get the ECB to think about that, but really, whether you want to call it a crisis or a really deep recession, if that comes to fruition, I have no doubt that that negative rate tool option is there in the European Union. They've used it before.
Just to underscore that, the ECB dropped the reference to keeping rates restrictive in this latest memorandum, in this latest rate decision. How big of a shift is that, just to underscore in their rhetoric, in their approach, when previously they'd been talking about inflation as really the preeminent concern?
Yeah, I think this is definitely I think everyone knew that they were going back to neutral. The market was already pricing some probability they'd go into accommodative territory, but I think this really crystallizes the break between the ECB and the Fed. and that the Fed is still talking about keeping rates sufficiently restrictive to ensure that they bring inflation down from the high side, where now the ECB is officially basically endorsing that they're going to need to go not only to neutral, but maybe below, and that's how they're going to stabilize inflation.
With this divergence potentially widening, at what point do we have to worry about a strong dollar becoming an actual disruptive force in global markets?
So it tends to be not just the strength of the dollar, but the magnitude of the moves. It's when you get really multi-standard deviation moves over a month or two or three that you start to see other central banks, whether they be in emerging markets or others, start to respond, whether they be through outright FX intervention or trying to not cut as much as maybe the market is pricing. I don't think we're there. The dollar's not as strong as it was in the second half of 2022. It's not as overvalued either. And I think, again, the dollar is just kind of the byproduct of this divergence. And so, at least at the private bank, we're continuing to lean into it. We don't think that this trip is over.
Sam Azif of JP Morgan Private Bank, thank you. Other people are probably going to say the trip to Europe probably isn't over as well from the United States. And what we're seeing right now, just to reiterate, if you are joining us, the ECB did cut by 25 basis points as expected. But really, Danny, the rhetoric going forward is what's catching a lot of people's attention.
Exactly, because they had in their statement in the past that they were keeping rates sufficiently restrictive. They've now dropped that from their statement. And I think Sam so rightly points out that this is the divergence. They might be cutting 25 basis points, much like the Fed is expected to, but they're leaning dovish in a big way that shows that they are now trying to support the economy versus dampening inflation down.
And Sam's right. The rhetoric when Christine Lagarde comes out, it's going to be about, is she leaning towards maybe doing this sooner, January, for that 50 basis points, or is it going to be down the line in March? Are they going to try to maybe get ahead of some of the tariffs coming out of Washington, D.C., or are they going to wait to see what Trump does maybe in this first month or 2 months in office?
Divergence, definitely the theme of the year and theme heading into next. Coming up next, breaking down PPI as well as jobless claims here in the United States. The expectation for ongoing resilience, the strength, this idea of how much inflationary pressure is this as we talk about the potential for negative rates in Europe. Dana Peterson of the Conference Board and Scott Cronard of Citi, both here to react.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
there is this real momentum from Wall Street. We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
About 25 seconds until we get PPI as well as initial jobless claims. Here's the state of play in markets. We're seeing equities just basically pull back a little bit from earlier lows, but still lower on the day after yesterday. NASDAQ futures, NASDAQ closing at all-time highs. We are expecting here for PPI final demand year over year to be 2.6% versus 2.4% in the prior reading. Maybe this is why yields are inflecting higher. Let's head over to Michael McKee, the Bloomberg Economics and Policy correspondent, who has all of the numbers. Mike, what do you see?
Well, this is a bit of a disappointment for those who are hoping the Fed doesn't move interest rates, or actually hoping the Fed does move interest rates, because inflation comes in faster in the PPI than anticipated on a headline basis, up 0.4, which pushes the year over year to 3%. Remember, you were just suggesting that the consensus was for 2.6, so this is a big jump over 2.4 last month. Core comes in up 0.2, which is what was forecast. That's down from the 0.3 in the month of October, and the core minus trade services as well is only up 0.1. So you put those all together, and it isn't as bad as that headline number sounds. We'll have to see what pushed that up on a year-over-year basis. Final demand, as I mentioned, 3%. Food and energy core 3.4%, up from 3.1, and ex-food, energy, and trade 3.5%. Now, jobless claims, here's an interesting one. 242,000 jobs, a big jump in jobless claims after 225 the week before. So there is a case here for weakening in the labor market that perhaps the Fed wants to take a look at when it considers whether to cut rates or not.
Mike, I'll let you dig through some of the details right now. Here's what you're seeing in markets. Kind of interesting. Seems like bond traders are taking more of their tell from initial jobless claims than they are from the inflation rate across PPI. Yields lower across the board. On futures, you are seeing an extension of those declines, but the yield space is what I have my eye on. Two-year yields actually now lower on the day to 4.15%. Again, initial jobless claims coming in at 242,000 versus the expectation for 220. What you can see across the board, ongoing dollar strength, but it's not because of the U.S. side of things, and that is the interesting aspect. This is about it being worse on the other side of the pond, but lessening some of that dollar dominance that we saw immediately after the ECB rate decision. Mike, just want to get your thoughts on why we seem to be seeing a market that is focusing much more on the jobless picture and initial jobless claims than to the fact that PPI came in significantly hotter than we previously expected.
Well, the market is looking at what the Fed might do, and the Fed has talked about its concerns about the labor market weakening as their major sign of weakness in the overall economy that could be coming. So they're going to react to labor market data more than they will to perhaps inflation data. And of course, PPI doesn't translate specifically into CPI. And this is just the headline number, and there is a very good reason for it. And I know Anne-Marie's going to be interested in this. According to the Bureau of Labor Statistics, the jump in the headline number was 80% because of final demand foods. And as far as that is concerned, 54.6% jump in the price of eggs. I remember what Donald Trump said the other day. He was elected because of the price of eggs. So we saw a little bit of this in the CPI, but that's a rather huge jump for egg prices.
Thank you, our chief egg correspondent, Michael McKee, for that update. Joining us now is Dana Peterson of the Conference Board. Dana, I just want to get your take on what we're seeing right now, which is definitely signs that inflation is sticky in the United States. But this 242,000 initial jobless claims, should we be concerned?
I'm not sure about that. It's one number. We need more data. And certainly 240 is still very low. Very few people being let go. Companies are not looking to let people go, at least when we ask the CEOs of the largest firms, and that's because they need those people. They're also paying higher wages. So I don't really see a labor market right now that's weakening. And even in the payrolls data that we did see, it was all mainly very good.
Dana, unfortunately, I feel like this is becoming an evergreen question, but just looking at today's data, the data we've been getting, how much is it distorted? How much can we trust the data? Are we still working through some of these weather effects, some of the strike effects, things like that?
I don't think so. I think we're beyond the weather and the strike effects, and it's important to kind of dig beneath the surface and see which states popped in the week. And again, we could see reversals in the next week. Jobless claims, you really need to look at the 4-week moving average. When it comes to inflation, a lot of the egg inflation is because of the bird flu. It's not necessarily because companies are trying to get away with something. It's really just this external shock. But absolutely, inflation is sticky. We saw that in the CPI data. Some of it's structural. You have fewer people working because they're retiring. That's raising wages, and that's following through in inflation. Insurance costs are rising across the board, and also shelter costs are not falling as quickly as you would expect. So all those things are keeping inflation sticky.
So putting the idiosyncratic story around eggs specifically, the fact that PPI final demand, though, is higher, are you more concerned at this point with inflation or the labor market?
I'm more concerned about inflation. Again, the labor market seems to be doing well. You know, even when we have bumps and bruises, it comes back. Most people are working. The unemployment rate's super low. The number of people who are saying they're unemployed, many of them are actually new entrants or returning to the labor market. And you wouldn't do that if you felt that the labor market wasn't strong. But I think the main issue is inflation. You have these structural factors and these supply shocks that are driving inflation higher, things that the Fed can't really lean against. And certainly when we head into next year, we could have shocks from either trade or fiscal policy that could cause inflation to be even higher. And the Fed's going to have to lean against all of that.
Well, Dana, one thing that I know you know very well is that sentiment has really started to shift. And we know how closely a lot of the sentiment is tied to the political environment. Previously in the Biden administration, you had this mismatch where hard data was strong, the soft data was far behind it. The soft data just did a 180 to catch up with where the hard data is. Does that mean it's just reality is more closely aligned, things now make sense, or are you all of a sudden going to see this big change in behavior in both consumers and companies?
Well, our measure of consumer confidence was sliding a little bit earlier in the year, and then it recovered. And even the November reading was very strong. When we look beneath the surface, a lot of it is about labor markets. It's about jobs. Consumers think that the labor market right now, it's easy to get a job, easier to get a job than not. And looking out into the future, our expectations gauge has been positive, on net positive, for 2 months. And that's after almost a year of being negative, even though most people were working. So I think the fact that consumers are more confident that they're going to stay employed, that's going to support consumption going forward. Is there a lot of uncertainty, especially around taxes? And if there are any trade issues that cause inflation to rise, yes, consumers are thinking about that. But for now, they're confident.
Dana Peterson of the Conference Board, thank you so much for being with us. Joining us now is Scott Cronert of Citi as we ask the question, how bullish can you get heading into next year with American exceptionalism rolling off everybody's tongue? So, Scott, why are you not the most bullish one on the street?
I just think we have to allow for the starting point, right? Valuation's very extended, 24, 25 times earnings. If you look at forward 12-month returns historically from this valuation starting point, S&P's down 9%. If you look at where the sentiment indicators are right now, our Lekovich index, from these levels historically, forward 12-month returns down 9%, right? So while we're quite constructive on the fundamental setup going into next year, and it potentially even gets better as we get further down the Trump policy path, we have to allow that somewhere in here, Dana used the word shock, It's a big term for me as well. We have to look for, the risk of some shock effect coming in that distorts sort of the euphoria that we've been contending with over the past couple of months, particularly as we've seen this major flow surge go into U.S. equities on the heels of the election.
It's a weird one because there is so much uncertainty. To your point that there could be shocks, there are so many unknowns, and there are a lot of known unknowns, a lot of gray swans, yet everybody is crowding around a very bullish case for 2025. In putting together your year-ahead outlook, how difficult was it? Was it a pretty simple call to say we're going to keep rallying, things are going to look great? Or was it more difficult than most years? Again, just given the sort of political shift that this market's likely to undertake.
The data says you ought to be a little bit cautious here, right? And so the way we're navigating this is that when I look at the transition here from administration, so we're going from election uncertainty to policy uncertainty, okay? We're starting to see the appointee list extend. Now, what we have to begin to prepare for is that there's going to be some noise as we get further down the policy path, okay? What does the platform actually look like? How do you implement many of these initiatives that Trump is all about? On the other side of that, you start looking and thinking about policy opportunity. Okay, great. We've digested the news. We've gotten the platform. We've got the appointees in place, okay? And all of that's happening during the first quarter as Q4 earnings are being reported. Then from there, you get to a point where you can start looking more constructively at the outlook, because at that point, you alleviate the uncertainty. You ought to begin to see corporates get a little bit more aggressive with things like growth CapEx, which is a good leading indicator of future growth. So ultimately, where all this goes, we got to navigate a period in here. I'm going to call it sort of first quarter, where we're looking for a volatility episode of some form. But then beyond that, you begin to extend out into the middle part of the year. You look forward to 2026, earnings growth continues. And the world's a pretty good place, particularly if you're focused on U.S. large cap equities. We think the opportunity set is probably even better in that context, going down cap into small mid cap. So all told, we're quite constructive on the outlook for U.S. Equity fundamentals. It's just a question of timing this around the current setup as we kind of go through this flow flush into year end.
But what's to say the shocks might be for something on the downside? Donald Trump is going to be ringing the opening bell today. This is an individual who's been regulated in the past by the Dow Jones.
So we know that and you look at who he's surrounding himself with in terms of appointees. I think the good news is that there's a market friendliness aspect of what's going on, and there's an attentiveness, and this is really important in our view, attentiveness to how you stimulate growth, how you balance that with some of the tariff talk, with some of the deregulatory talk. But importantly, what I think is most encouraging for us is that you've got some individuals in place that are a little bit more focused as well on the spending side of the equation. 6 months ago, as we were kind of navigating through the election diatribe, there was almost no focus on how do you think about cutting spending. What the market really wants longer term is a sense that there's some sanity at work here, that we get it. We need to stimulate economic activity, but we have to do it in a judicious fashion. We're very attentive to where the deficit math has taken us.
So your base case is 6,500 for year end next year. Your bull case is 6,900. Bear case is 5,100. I'm just curious within that. You said you're constructive down cap. Do you think that small caps will do the best, and is this contingent on rate cuts?
I don't think it's contingent on rate cuts. I think small cap is the best setup, if you will. The valuation hurdles, the lowest of the various asset classes within equities. What's really important is that where consensus numbers are taking you right now is that small cap hasn't had any earnings growth for the past 2 years. It's been lagging well behind large cap in that regard. The math right now is that large cap earnings growth, particularly for the Mag 7, begins to decelerate off a lot of large numbers going into next year. The sentiment, the consensus numbers are also pointing towards small cap seeing sort of a growth acceleration. So what you're looking at here is this bigger theme in the market of what we're going to call earnings growth differentials narrowing. What that ends up doing is supporting the case for areas such as small cap, probably the value side of the market as well, and it even allows you to expand out the economic sensitive side.
I'm pretty flexible. I think a good starting salary is like
the broadening that we're
60,
looking for
so like
from a fundamental
100,000.
perspective is part of ultimately how and why we stay constructive. It's just a measure. At this point, it's really just a matter of timing your entry points.
Scott Kroner, wonderful to see you in person. Scott Kroner of Citigroup here with us in New York. Up next, setting you up for the day ahead, including ECB President Christine Lagarde's news conference, which we will be taking live. This is Bloomberg Surveillance.
Very expensive to hire, even at the junior end of the market. You're looking at minimum 30K.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Futures lower ahead of the opening bell here in New York after getting initial jobless claims that exceeded expectations, not necessarily more than before. S&P futures down by about 0.25%. What you could see is yields marginally higher in the U.S., dollar ascendant as you see rate cuts across the board. Here's a trading diary through next week after we get the ECB rate decision, or the press conference with Christine Lagarde in just moments. Monday, we have the S&P global PMIs. On Tuesday, we have retail sales. On Wednesday, we'll get a Fed rate decision at 2 p.m. Eastern, followed by a Chair Powell news conference. Thursday, another round of jobless claims, and Friday, core PCE and UMich sentiment as we watch Christine Lagarde come to the podium. Danny, what are you listening for to hear what she has to say?
Well, clearly the statement, the doves have had their way in terms of removing restrictive from the statement. Does Christine Lagarde reflect that? Or is this a Lagarde who's going to be, as she has been, really reserved and talk about data by data and the meeting depending on that, rather than projecting forward and any sort of accommodation they might need for the weakness to come?
For me, it's the split screen, the difference of the ocean, whether it's the S&B, the ECB, and how much more difficult their job is going to be because Donald Trump and his presidency, and he's going to be ringing the opening bell at 9:30 this morning at the NYSE.
Yeah, especially at a time where this was an ECB that removed reference to keeping rates restrictive at a time where they're concerned about growth. There is going to be a question asked to Christine Lagarde in this press conference. Why did you not cut by 50 basis points at this meeting if you were concerned about growth? How she answers that, Anne-Marie, could really determine what we see in markets.
Potentially, and what we could see next year. Does she go for 50 basis points in January, or does she potentially hold off and wait for March?
And at a certain point, you have to wonder how much this really does leave the dollar ascendant at a time where it's hard to see where the nodes of growth are. Just to recap, the ECB did cut rates by 25 basis points. What they are looking for is to remove restrictive as in terms of what they want to see for their rates in their statement. And right now you see opening statements from de Guindos ahead of Christine Lagarde's speech. I'm just curious, though, at what point, Danny, do we end up seeing this divergence become a difficult thing to maintain? There was such a long time that we talked about how at a certain point you had to see that gap close in a global market.
Right, and at what point does a strong dollar become a problem for everybody? We are seeing the dollar strengthen this morning.
ECB President Christine Lagarde getting underway with her news conference.
Today decided to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate, the rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. The disinflation process is well on track. Staff see headline inflation averaging 2.4% in 24, 2.1% in 25, 1.9% in 26, and 2.1% in 27 when the expanded EU emissions trading system becomes operational. For inflation excluding energy and food, staff project an average of 2.9% in 24, 2.3% in 25, and 1.9% both in 26 and 27. Most measures of underlying inflation suggest that inflation will settle at around our 2% medium-term target on a sustained basis. Domestic inflation has edged down but remains high, mostly because wages and prices in certain sectors are still adjusting to the past inflation surge with a substantial delay. Financing conditions are easing as our recent interest rate cuts gradually make new borrowing less expensive for firms and households. But they continue to be tight because our monetary policy remains restrictive and past interest rate hikes are still transmitting to the outstanding stock of credit. Staff now expects a slower economic recovery than in the September projections. Although growth picked up in the third quarter of this year, survey indicators suggest it has slowed in the current quarter. Staff see the economy growing by 0.7% in 24, 1.1% in 25, 1.4% in 26, and 1.3% in 27. The projected recovery rests mainly on rising real incomes, which should allow households to consume more and firms increasing investment. Over time, the gradually fading effects of restrictive monetary policy should support a pickup in domestic demand. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decision taken today are set out in a press release available on our website. And I will now outline in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity. The economy grew by 0.4% in the third quarter, exceeding expectations. Growth was driven mainly by an increase in consumption, partly reflecting one-off factors that boosted tourism over the summer, and by firms building up inventories. But the latest information suggests it is losing momentum. Surveys indicate that manufacturing is still contracting, and growth in services is slowing. Firms are holding back their investment, with some European industries finding it challenging to remain competitive. The labor market remains resilient. Employment grew by 0.2% in the third quarter, again by more than expected. The unemployment rate remained at its historical low of 6.3% in October. Meanwhile, demand for labor continues to weaken. The job vacancy rate declined to 2.5% in the third quarter, 0.8 percentage points below its peak, and surveys also point to fewer jobs being created in the current quarter. The economy should strengthen over time, although more slowly than previously expected. The rise in real wages should strengthen household spending. More affordable credit should boost consumption and investment. Provided trade tensions do not escalate, exports should support the recovery as global demand rises. Fiscal and structural policies should make the economy more productive, competitive, and resilient. It is crucial to swiftly follow up with concrete and ambitious structural policies on Mario Draghi's proposals for enhancing European competitiveness and Enrico Letta's proposals for empowering the single market. We welcome the European Commission's assessment of governments' medium-term plans for fiscal and structural policies as part of the EU's revised economic governance framework. Governments should now focus on implementing their commitments under this framework fully and without delay. And this will help bring down budget deficits and debt ratios on a sustained basis, while prioritizing growth-enhancing reforms and investment. Turning now to inflation. Annual inflation increased to 2.3% in November, according to Eurostat's flash estimates, from 2% in October. The increase was expected and primarily reflected an energy-related upward base effect. Food price inflation edged down to 2.8% and services inflation to 3.9%. Goods inflation went up to 0.7%. Domestic inflation, which closely tracks services inflation, again eased somewhat in October, but at 4.2%, it remains high. This reflects strong wage pressures and the fact that some services prices are still adjusting with a delay to the past inflation surge. That said, underlying inflation is overall developing in line with a sustained return of inflation to target. The increase in compensation per employee moderated to 4.4% in the third quarter from 4.7% in the second. Amid stable productivity, this contributed to slower growth in unit labor costs. Staff expect labor costs to increase more slowly over the projection horizon as a result of lower wage growth and higher productivity growth. Moreover, profits should continue to partially offset the effects of higher labor costs on prices, especially in the near term. We expect inflation to fluctuate around its current level in the near term, as previous sharp falls in energy prices continue to drop out of the annual rates. It should then settle sustainably at around the 2% medium target. Easing labor cost pressures and the continuing impact of our past monetary policy tightening on consumer prices should help this process. Most measures of longer-term inflation expectations stand at around 2%, and market-based indicators of medium to longer-term inflation compensation have decreased measurably since the Governing Council October meeting. So let's look at the risk assessment. The risks to economic growth remain tilted to the downside. The risk of greater friction in global trade could weigh on euro area growth by dampening exports and weakening the global economy. Lower confidence could prevent consumption and investment from recovering as fast as expected. This could be amplified by geopolitical risks such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, which could disrupt energy supplies and global trade. Growth could also be lower if the lagged effects of monetary policy tightening last longer than expected. It could be higher if easier financing conditions and falling inflation allow domestic consumption and investment to rebound faster. Inflation could turn out higher if wages or profits increase by more than expected. Upside risks to inflation also stem from the heightened geopolitical tensions, which could push energy prices and freight costs higher in the near term and disrupt global trade. Moreover, extreme weather events and the unfolding climate crisis more broadly could drive up food prices by more than expected. By contrast, inflation may surprise on the downside if low confidence and concerns about geopolitical events prevent consumption and investment from recovering as fast as expected, if monetary policy dampens demand more than expected, or if the economic environment in the rest of the world worsens unexpectedly. Greater friction in global trade would make the euro area inflation outlook more uncertain. Financial and monetary conditions now. Market interest rates in the euro area have declined further since our October meeting, reflecting the perceived worsening of the economic outlook. Although financing conditions remain restrictive, our interest rate cuts are gradually making it less expensive for firms and households to borrow. The average interest rate on new loans to firms was 4.7% in October, more than half a percentage point below its peak a year earlier. The cost of issuing market-based debt has fallen by more than a percentage point since its peak. The average rate on new mortgages at 3.6% in October is about half a percentage point lower than its highest point in 2023, even though the average rate on the outstanding stock of mortgages is still set to rise. Bank lending to firms has gradually picked up from low levels and increased by 1.3% in October compared with a year earlier. Debt securities issued by firms were up 3.1% in annual terms, which was similar to the increase in the previous few months. Mortgage lending continued to rise gradually in October with an annual growth rate of 0.8%. In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability. Euro area banks remain resilient, and there are few signs of financial market stress. Financial stability risks, nonetheless.
All right, let's get over to President Trump. He is speaking now at the New York Stock Exchange. You can continue watching the ECB if you like on your Bloomberg terminal using Live Go. Here's President Trump.
Time Magazine getting this honor for the second time. I think I like it better this time, actually, because but we did a good job. We had a great first term, despite a lot of turmoil caused unnecessarily. But the media's tamed down a little bit. They're liking us much better now, I think. If they don't, we'll have to just take them on again, and we don't want to do that. But I do want to thank Time Magazine. I've been on the cover many times. I don't know who has the record, but I can only probably talk well about 25% of the covers. 25% are great. The others I just sort of hide. But it's been an honor, and every time it's an honor, I will tell you. And thank you very much for doing it. And thank the whole group at Time. Really very professional people. Thank you very much. And to Jeff and all of the people from the New York Stock Exchange. He knows how much I like it because many years ago I bought a building across the street. I wasn't going to buy it. Then I said, you know, it's right next to the New York Stock Exchange. I'm going to buy it. We've had great success. 40 Wall Street, we've had tremendous success with it. But you've really had success with the New York Stock Exchange. It's an incredible group of people. And Jeff, you have done an incredible job, you and your group. And what a beautiful speech you made. Thank you very much. I was some introduction of all of us. But we've gone up since the election. I was just told by Scott, everybody said, you have to pick Scott Bessent. He has to be the one chosen for Treasury. Where is Scott? Let's see. He's around here someplace. He's around here. he told me we picked up $3 trillion since the election day. And I said, well, that's good, but what about before the election day? He said, we picked up some money there because they thought you were going to win. I said, I like this guy. He's going to be my Treasury Secretary. But it's true. I think we're going to have a tremendous run. We have to straighten out some problems, some big problems in the world. When we left, we didn't have any of these problems. We didn't have Russia with Ukraine. We didn't have Israel October 7th. We didn't have the Afghanistan disaster. We didn't have inflation. We had no inflation. And we had a very strong economy. And we're going to do that again, but I think we're going to even up it because now we have experience that we didn't have. Now I know everybody. You know, when I first came in, we came down, Melania and I, a great first lady, who's very popular, by the way. She rang in. She rang in the bell. She rang in the bell. But we came down and we're driving down Pennsylvania Avenue, and it was so beautiful. I said, you know, I've never done this before. I didn't know anybody. I got to the Oval Office, and I'm picking all these big positions, and I didn't really know the people in Washington, but boy, did I get to learn fast. And now we do, and I think we have an incredible staff behind me and others that aren't here. And we're going to do a fantastic job. We're going to create the incentive theory again. In fact, I just announced yesterday, I didn't announce it for this reason, but anybody investing $1 billion or more gets a very expedited approval process because, you know, the approvals, when people come into the country, it takes them, in many cases, 14, 15, 16 years to get the approval. We have Lee is around here someplace. He's in charge of the environment, and that's Lee Zeldin, who ran an incredible race for governor in New York, was a very, very successful guy before that. He was a great congressman, and he's a fantastic lawyer. He's in charge of environmental, and we'll try and push him as much as possible to get those permits very quickly. Like a nuclear power plant, I would say a week would be enough time. What do you think? Is that okay? We're going to get fast approvals, and it's great that we have Lee and all of the people behind. They're all stars in their own way. But it is an honor, and this is a double because usually they don't coordinate the Man of the Year or the Person of the Year with the ringing of the bell. And brilliantly, you picked them both at the same time, and you were all friends, and you said, let's do it. And it takes one trip. It doesn't take two trips. That's okay. We like to save. We like to be able to do it properly. But this is a special group. So many friends in the audience, too. John, great job you've done at ABC. I'm really proud of you, and you've been so nice to me. Otherwise, I wouldn't actually acknowledge you at all. But you have been, that really is, it's a terrific job you've done. But again, I want to thank you. We're going down to ring the bell now, and I could just say that the economy, I believe, is going to be very strong. We do have to solve some problems. We have wars going on that we didn't have. We have a lot of things happening that we didn't have that would have never happened. They would have never happened, but now they have happened. And I want to get them solved. We have to get them solved because ultimately the power of weaponry today is the biggest threat we have, in my opinion. It's not some of the other things that you read about. It's the power of weaponry. The weapons are so powerful, so devastating. And I rebuilt our military. I got to know every one of them, including nuclear weapons. I hated to do it. Actually, I hated to do it. But we did some nuclear weapons that are so devastating and almost makes you very sad as you get them and as they come online. It makes you very sad because you know what the purpose of them is, and you just hope to God that you never have to use them. Because if you do, the world will never be the same. So we have to be very, very smart. We have to be very sharp. We have to be very special to do a job. And I think we'll get it done. And I think we're going to get a lot of people in the room. We've seen it. We were in France where President Macron did a fantastic job with the cathedral, an absolutely fantastic job of Notre Dame. And it was beautiful. The opening was the opening, and I just got back, and it was something really beautiful. And a lot of world leaders there. We had about 80 world leaders, different countries, and they were all coming together. They all wanted to meet us and meet me as representative of the U.S., and there was a lot of goodwill. But we're going to get some really tremendous goodwill. I was even thinking about inviting certain people to the inauguration, and some people said, wow, that's a little risky, isn't it? And I said, maybe it is. We'll see. We'll see what happens. But we like to take little chances, but that's not a bad chance. Here's a gentleman that's going to do a great job at HUD. Good luck, my friend, right? He's going to be a he's been my friend for a long time. It's nice to see you. I haven't shaken his hand yet. Come on. Congratulations. Thanks. Really, you're going to be great. And Ben Carson is your biggest fan in the world. You know that. Ben has been with us for a long time and has done a fantastic job. Thank you. Good. So, ladies and gentlemen, go on. We're going to put it straight. We're going to give tremendous incentive like no other country has. We're cutting your taxes. We're going to cut them very substantially. We got them down to 21% from probably 42 or 44%, depending on where you are. And we got them down to 21. Everyone said that was a miracle. Now we're getting them down to 15, but only if you make your product here. Otherwise, you pay 21, which is not bad. It's in the middle of the pack. But 15 brings you down to among the lower. And for those that are running the big companies, those great, big, beautiful companies, nobody's going to be leaving us. You're going to be coming back. You're going to be bringing it back to the United States. We are incentivizing everybody to come back to the United States. We want you back here. Car manufacturers, everybody. And we have one product that nobody has really to the extent that we do. It's called oil and gas. There is no country in the world that has more. We're number one. I brought it to number one during my first term in terms of production. We're going to be number one plus. We'll do numbers that nobody will really see before. And when that happens, prices are going to start coming down because people can't afford their groceries, and they're going to be affording their groceries very soon. I tell the story about a woman an old woman, no money, went to a grocery store, had 3 apples. She put them down on the counter, and she looked, and she saw the price, and she said, "Would you excuse me?" And she walked one of the apples back to the refrigerator and came back to pay for the 2 apples. And she left with 2 apples. And the woman at the counter said that was so sad. And when I heard about the story, I said, that should never happen in America. And it's not going to happen in America. We're going to do it right. And we're going to take care of our people. And we're going to do things that nobody ever thought even were possible. But we're going to have an economy the likes of which nobody's ever seen before, and everybody's coming back to America. I saw that the other day at the cathedral. They're all saying, we want to come back, we want to come back. And with a couple of changes done by Howard and Scott and some of the great people up here with me, we're going to bring them all back. They're all coming back. So thank you very much. This is a great honor, and ringing the bell will be fantastic. And go out and get them. We're with you all the way. Thank you very much. Thank you.
And that was President Donald Trump there speaking at the New York Stock Exchange. He was chosen as Times Person of the Year again. He is going to ring the bell to commemorate that at the New York Stock Exchange. I want to bring in Anne-Marie Hordern right now, Bloomberg's chief political correspondent. She is the co-host of Surveillance. I should also say welcome to Bloomberg Open Interest.
Thank you so much for having me.
We've switched feeds here. Great to have you on set. Interesting speech there from President Trump. Obviously not as long as some of his rallies, but he brings up...
Well, he's got the bell to get to. So.
Yes, exactly. He's got to open
He's got to get up the
trading.
stairs.
What do you think was most important? I mean, he talked about the expedited allowance for people who invest more than $1 billion. He talks about weaponry in Ukraine. He talks about cutting taxes, oil and gas. What did you take from that?
What I took from it is what he didn't say. I don't believe he mentioned the word tariffs once. And he has been on a campaign trail talking about how this is the most beautiful word. And that says to me, this is going to be a Donald Trump that, like Donald Trump in 1.0, 2.0 is going to be similar in the way that this is going to be what he's regulated by, the stock exchange and stocks, and whether or not the Dow Jones Industrial Average is red or green on any single day. And the fact is, what you hear from analysts, what you hear from corporate executives, if you read the earnings report, what people are most nervous about is they like all the good stuff that Trump could mean for them. He talked about lowering the tax rate. He talked about deregulation. Come invest in America. We're going to make it easier for you. But he didn't talk about the walls going up. And that has been one of the biggest concerns you hear from individuals on Wall Street. And that's what they would say is the bad things potentially that can happen in Trump 2.0. And in this room downtown, he probably knew that, and he knew who he was talking to, and he didn't mention it once.
It's interesting. There was what he was saying, then there's who he was with. It was interesting to see who was not only there with him at the stock exchange, but who was right behind him. Scott Bessent, Kelly Loeffler.
Right behind him was not the individuals who are also really leaning into this idea that the wall should go up 60% when it comes to Chinese imports, 10% when it comes to the rest of the world. Look, they were all there, but right directly behind him was his Treasury pick, who we know was applauded when he was picked as the individual. Remember that Game of Thrones went on for days, who was he gonna pick? And he picked someone that Wall Street actually looked kindly on, and that was the man directly behind him. Also notable, his family was there. We haven't seen a ton of Melania Trump, his wife, the First Lady, on the campaign trail, but she was there alongside Ivanka Trump, some other members of his family behind him, as he is not just ringing in the bell, which is very Trump trade of him, leaning into this idea, but also the fact that he was named Time Person of the Year today by Time Magazine.
Yeah, really interesting who's who. RFK Jr. was also there. I want to talk about the Time Person of the Year honor, though, because he seemed very warm in his comments towards Time. And, of course, he said that he liked this go-around better than he liked it last time in 2016. You think back to 2020, it was Joe Biden and Kamala Harris who were named. So it's become a bit of a tradition here.
Well, I also think that you do see individuals lining up differently. The rhetoric you're seeing from executives towards Trump this time around than you have in the past. Look at what Meta did overnight. It's a nominal amount for Meta, $1 million, but they're donating to Trump's inaugural committee. They did not do this for Joe Biden, and they didn't do it for Trump 1.0. And this just builds on the fact that you see tech executives and either other executives realizing that they need to make sure that they're in the room or have a direct relationship with President Trump. They've seen what Elon Musk has done. They've seen how helpful it has been to his company, to his personal wealth. Even GM's Mary Barra, speaking in Axios, was saying how there is some similarities and some synergies within the Trump transition team and their campaign that we would like to see. Notable as well, one other thing. He mentioned this in the Time magazine, and he also talked about it there at the NICE. He talked about Ukraine. And when he was pressed, according to Time magazine, about if he would abandon Ukraine, he did say the only way you're going to reach an agreement is not to abandon. So maybe he comes in on full support of Ukraine to try to get these two individuals to the table.
I want to comment really quickly on what you said about Meta. Over the last week, I was talking to a senior banking executive that said they looked at what the crypto industry had done, and they're looking at that playbook, asking why they're not taking more advantage of Citizens United and pouring more money into races and looking to make a bigger mark on policy moving forward.
Yeah, you got to kiss the ring, right? In terms of Ukraine, I think it's fascinating as well. The fact that he brought up here the importance of the weaponry, right? And he talked in the Time magazine article about the fact that we're sending so many missiles there. He doesn't seem comfortable with it personally, but we know that people, especially from his last administration, like Mike Pompeo, have urged him to blitz the Russians with serious funding, like $600 billion worth. And the Russians already seem at their wits' end, right? They can't hold up their puppet dictatorship in Syria. They're bringing in North Koreans because they're running out of their own soldiers. It does seem like almost a Reagan moment, you know, in terms of pushing them to the brink with funding. Does Trump, do you think, change his tone on that?
It would be to escalate, to de-escalate, force this, give Ukraine everything they could. You know, you have to remember, Trump 1.0 was the first administration to send javelins to Ukraine. So you could see him potentially say, I am going to do everything we can to put the pressure on Putin to force him to the negotiating table, because he says he wants to reach that agreement. Now, also, the Biden administration may give him a layup before he comes in. We have reporting this week that they're potentially going to go the harshest they have ever been in terms of sanctioning Russian oil outright, portions of Russian crude exports outright. So not going through a price cap, the same way the United States has sanctions on Iranian crude. And this is how Putin has been able to fund his war. It has been the ability to continue making money off those exports in the fossil fuel industry.
All right, Anne-Marie Hordern, that is our chief political correspondent, also the co-host of Surveillance, breaking down President-elect Donald Trump's remarks ahead of the opening bell, which he will be ringing. Let's check on markets in the meantime, because it's been a busy day already. Of course, we got some economic data at 8:30, jobless claims coming in higher than expected. So too did PPI. You take a look at how it's working its way through the markets. Futures down right now. The S&P 500 down about 0.3%, seemingly responding to PPI rather than some picture here of the weakening labor market. And you can see it just gets worse as you go on. Big tech also taking a dive, down about 0.5%. The Russell 2000 down about 0.4%. Much more markets coverage coming up as we count down to those opening bells. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
All right, welcome back to Bloomberg Open Interest. Opening on a down note, at least we're poised to, because the S&P 500 down about 0.2% after yesterday's rally. Same thing, too, if you take a look at big tech, if you take a look at the small caps. Of course, we're digesting what we saw from the Swiss National Bank, from the ECB. Let's break it all down as we count down to the Fed next week. Because joining us now is Invesco Head of Investment Solutions, Alessio De Longis. So a bit of a dovish surprise from the Swiss National Bank. Of course, the ECB cutting rates as expected. Is there any chance that we get some sort of surprise for the Fed next week? Because right now, it's all but baked in that we're going to get a 25 basis point cut.
I think the chances of a dovish surprise are, or any kind of surprise are very, very limited. The Fed has really committed to the necessity of a gradual but steady rate cutting cycle, and they actually started with a bang with a 50 basis points initially. So I think no surprises. All central banks are really on a mission to bring rates close to neutral as soon as possible. There is a big debate, of course, where neutral is, but by and large, we expect that trend to continue now in December and for most of 2025, bearing any surprise.
What's your take right now, Alessio, on where neutral is? Are we talking about, 3 and change, or are we talking about 4?
When you look at the estimates of the Federal Reserve through proper academic research, the ranges are quite wide, and we range between 2.4, 3.7%. So that's quite a big range. My own estimate would be closer to the upper end of that range, right? Productivity seems to be increasing, so the real neutral rate is certainly higher today between both productivity and the supply-demand changing dynamics due to demographics. Probably 3.5 it seems about right from my perspective, but obviously there's a large degree of uncertainty around these estimates.
I think a lot of investors have been looking over the last couple of years for any sign of stagflation, and certainly some of the data this morning showed a little bit of a hint of it. How serious of a concern is that?
We're not very concerned about the stagflation risk at this stage. Let's remind ourselves that to begin with, the level of growth is quite high, is not suggesting that stagnant growth. The level of growth is still, especially in the United States, at trend, and that trend rate has been going up recently. With respect to the inflation side of the stagflation argument, we are seeing basically that disinflation trend of the past 18 months has come to a halt, is stalling, but we are not seeing a reacceleration in inflation per se. So I would say this is closer, if I had to pick, we are still closer to a Goldilocks scenario than a stagflation scenario.
All right, Alessio, stick with us, of course. You're joining us at the opening bell. That is Invesco's head of investment solutions, Alessio De Longis. We do have some breaking news, and this is from the Wall Street Journal, that Starboard Value has taken a stake in Bitcoin mining company Riot. That is a publicly listed Bitcoin miner. You can see shares popping right now, up almost 18.5%. A really interesting move, of course. Bitcoin has been impossible to ignore, and clearly Starboard has taken notice.
Well, part of this, according to the Wall Street Journal, is to make sure that it's pivoting away from just Bitcoin mining into using their capacities, their facilities for hyperscalers. This is something we have seen for other Bitcoin miners trying to move to the AI trade more than just the Bitcoin trade. Certainly both are quite lucrative.
You know, that is absolutely fascinating. I haven't even thought about that. Obviously, Bitcoin miners, their biggest problem was paying for power. So they've moved years ago to places where power was much more plentiful and much cheaper, and now that could be a huge advantage for AI. Although with Bitcoin at $100,000 a pop, it's pretty profitable itself. Coming up, less than 4 minutes to the opening bell. We're going to start the trading day right after the break with President Donald Trump, President-elect. Looking forward to him ringing the bell and signing the book. This is Bloomberg.
Saturday mornings, I understand you have off.
Yeah, Saturday is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife. We go for a swim all year round. After that, have a nice lunch, and then I'm on to a good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend as they fancy. I think what we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, the bandwidth of your reflection is just too narrow. And I generally believe that Monday mornings I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
All right, we are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We are looking at red arrows, slight, but still there. S&P futures down about 0.2%. NASDAQ futures down more than double that, almost 0.5% right now. You hear the opening bell, and you can see President Donald Trump ringing the opening bell down on the New York Stock Exchange to commemorate being chosen as Time Person of the Year again. He's got a cast of characters with him, including J.D. Vance, including Ivanka, including Melania, and I believe Tiffany there at the end. So a big group of people with him, his entire cabinet practically down on the floor of the New York Stock Exchange, watching him, looking up at him as he stands up on that podium. Someone ringing the bell at the NASDAQ market site too. But Donald Trump up there on the podium, he's going to come down, he's going to sign the book, which is more than a century old. If you ring the bell, you get to sign the book. It doesn't go all the way back to the Buttonwood Tree in 1792, but it does have a lot of history. And then he's going to walk around the floor and talk with some of the traders down there. Pete Giacchi, John O'Hara. He's going to talk with Frankie Marciello, Mikey P. It's going to be great, I'm sure, for them as well as for the president. Katie, what do you see in terms of the major averages right now?
Well, first of all, it's Service Titan over at the NASDAQ. I believe they're in IPO, but in any case, you take a look at the board behind me, and it isn't too pretty, of course. We saw a rally yesterday shaking off that downward tone that we developed at the start of the week, but clearly resuming declines right now. The S&P 500 down about 0.2%. Big Tech was your big winner yesterday. Today, it's the big loser, down about 0.5% on the NASDAQ 100. And then you take a look at the small caps right now, down about 0.3%. Of course, we got hotter than expected PPI. That follows an as expected inflation print, where inflation edged a little bit higher. So a lot of question marks about inflation heading into next week's Fed meeting. But in any case, let's take a look under the hood right now, because Warner Brothers Discovery announced a new corporate structure where the company will serve as the parent of two operating divisions, Global Linear Networks and Streaming and Studios. This frees the company up for strategic flexibility, and CEO David Zaslav has said that the entertainment industry needs more deals, Shonali.
Yeah, you have to wonder if splitting it up in two makes it easy to sell one of those two, but we'll keep an eye on that story as the months go along. Another story that investors like Uber higher after TD Cowen analysts praise the ride-hailing company's direction. Following an interview with the CFO, Cowen says the UberX arm should see growth of low to mid-teens year on year as driver numbers increase. Uber shares up about 2.6% as the market opens, Matt.
All right, I want to talk about Adobe as well. Those shares dropping. The company, its market cap decimated this morning as a sales forecast that's lower than anticipated comes out. That raises fear that AI startups could eat into the company's business. Adobe continues to see record customer adoption and usage of its AI tools, but that just isn't enough for investors. Let's bring in Bloomberg Technology co-host Caroline Hyde to find out what's going on here. Caroline, thanks so much for joining us here on set. Wow. More than 10% the drop at Adobe. What's the problem?
Worst day since March 2024, when it had a pretty ugly set of numbers back then too. And look, what is a company to do when it's beating on its fiscal fourth quarter results, 11% growth in revenue? They're managing to say that they got record adoption of their AI offerings. But the question is, there's no inflection point here. At what point are we starting to see more than an 11% increase in revenue, which is basically where we've been at for the last year or so? Investors really focusing in on that, look, they're wanting to see adoption, but that comes at the cost of monetization. And I think the real worry here is this new level of measurement they're using, digital media annual recurring revenue. That came in at about 11% in terms of the forecast, and that's actually slower than the fiscal fourth quarter of 13%. They're forecasting 11%. So once again, it's a question of forecasts not living up to hype, and actually there hasn't been much hype in this short stock for the year anyway.
Yeah, shares down about 17% right now, and obviously they've been left behind and then some in this AI race. And I find this interesting because Adobe, you think about their suite of products. For a lot of people, especially in creative industries, these are must-have tools, but the AI narrative, to not be a part of it, obviously really painful for Adobe.
And then wanting to see the cadence at which they're letting these new products come out. Look, Firefly has been embedded throughout Photoshop, and you're able to use it within video production, but the real AI generation of video, the equivalent to Sora, that we've seen get into people's hands this week alone at OpenAI, well, they're still not promising it until 2025. So it's like, when are people going to have this transformative technology from a video production perspective? They have really, though, been trying to interlace Firefly throughout the rest of the products. But the question is also, when you start charging more for it, they have hinted that subscriptions are going to get more costly, but that's now being sort of baked in.
They're already impossible to cancel. You know, it took me over a year to cancel an Adobe subscription, like the bane of my existence.
They're getting investigated for that.
I need AI to help me cancel my Adobe subscription.
Sure, there might be one for that.
I mean, speaking of AI stories, this this is the cost of not getting ahead in AI, isn't it? And you see throughout the year the people who were doubters for certain strategies. You think about Salesforce really turning the ship around there, and now we're coming to the come to Jesus moment, aren't we? We're like looking at these companies and saying you either have it or you don't.
And I think they've got a disconnect here. The executives are speaking incredibly optimistically about the adoption of generative AI at their business. The users, the customers love it. It's the investors who haven't quite gotten on board with this narrative yet.
Yeah, disconnect there. Obviously, you can see that in the stock as well. Caroline, great roundup. That, of course, is Bloomberg's Caroline Hyde. And let's get back now with Invesco Head of Investment Solutions, Alessio DeLongis. And I'm looking at your note. You write that you have a cautious asset allocation versus your benchmark, that you're overweighting fixed income relative to equities. That caught my eye because that seems like a pretty painful place to be. Bonds have been a basket case, and it feels like the stock market just goes up and to the right, Alessio.
It certainly has been a bit of a painful trade in the last couple of months. We have moved into this cautious stance, though, in the middle of the summer, and the relative performance between equities and fixed income was certainly much more on a bearish tone between July, August. As of today, we find ourselves legitimized more on the call with respect to still positioning towards quality and low volatility equities. We have seen a bit of fatigue with respect to the expected outperformance for cyclicals, such as mid caps and small caps. We continue to see false starts in that outperformance relative to the larger names. The challenge in this macro backdrop, in my opinion, is the following: that the stock market has been led by what traditionally are defensive sectors with quality and low volatility characteristics, right? So especially following the result of the election and some of the excessive optimism, in my opinion, around the outperformance of cyclicals, around the expectations for fiscal expansion and the benefits towards small and mid, we think that the combination of maintaining a cyclical defensive posture in the equity sector and taking advantage of the rise in bond yields in an easing cycle, it's probably prudent as we go into next year.
Hey, Alessio, we're just looking at Donald Trump. I guess he's signed that book down the New York Stock Exchange. Looks like he's doing an interview with Jim Cramer right now as well. I wonder if those two have a lot to talk about. What do you think you can take from 2016 when we were in the similar situation? You know, his win in 2016, driving up sort of animal spirits, driving up optimism for deregulation and lower taxes. Can you look at that and overlay it with now and make some calls on what's going to happen next year based on what you saw happen following his inauguration last time?
Well, you're bringing up a very interesting analogy, right? If you look at the 1 month following the 2016 election and the 1 month now following this election, the relative performance between asset classes has been incredibly remarkable, identical, nearly identical. Outperformance of small versus large, outperformance of U.S. equities relative to international stocks. In other words, pricing in a positive growth shock in the U.S. and a negative growth shock outside of the U.S. But then what happened in 2016, we saw a perfect reversal, a perfect unwind of those themes. Not because those policies didn't materialize, they actually did materialize, right? Fiscal expansion and antagonizing trade policy and increasing tariffs. But the reality is that those policies were fully priced in the 1 month following the election, and markets focused on other themes that emerged. At the time, it was a surprising acceleration in the global restocking of in the inventory cycle globally that was really led by emerging markets. Should that happen this time around? We don't know. But the point is, let's not overextend ourselves to what seems to be clear trades over the medium term when they are most likely already priced in.
Alessio, thanks so much for joining us. Really appreciate you sticking with us throughout the Trump bell-ringing ceremony there, Alessio DeLongis. Coming up, Lazard CEO Peter Orszag says President-elect Donald Trump is right to keep Fed Chair Powell in charge. Not that he has much other choice. We'll talk about that and much more next. This is Bloomberg.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot of it, to just give you very superficial ideas but at the end, you still have to customize and how to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment. Yeah.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I see that, when a designer doing it's the spirit, it's the heart that the computer don't have.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely.
To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
And it's time for today's Wall Street Beat. Lazard CEO Peter Orszag penning an opinion piece in the Washington Post, laying out the case for President-elect Trump to keep Jerome Powell in charge of the Fed. And he writes, quote, the incoming administration should stick to preserving the Federal Reserve's independence, not in fear to Washington norms, but because practical evidence shows that independent central banks produce lower inflation. Peter joins us now. And Peter, when you're thinking about not just what you wrote, this idea that the Fed should just do its job, right? But also about what role the fiscal plays in relation to the monetary. We've been seeing that push-pull already in the Biden administration, frankly. How much will you see it in the Trump administration with the threat of tariffs potentially driving inflation higher?
Well, I think one of the reasons why you've seen the long rate bump back up is because of concern that there are a variety of things that could be inflationary. But I would say the initial appointments, Treasury Secretary, I've known Kevin Hassett for a long time as NEC Director. These are very solid choices. And so there may be some tempering of the campaign promises that have been made in terms of their actual implementation. But directionally, many of the things that are under discussion would push inflation up, and that will make the Fed's job harder.
So over and over, all throughout the course of the week, and even since November, what you really heard from a lot of CEOs is pro-growth, deregulation. But if you think about tariffs or anything else that investors are actually afraid of, what are those things?
Well, first, on the regulatory front, we've also had appointments which I think do point towards the ending of the biggest bad era, not completely, but at least partially. And the biggest changes you'll see are on vertically integrated deals. That is where the biggest bad crowd under President Biden diverted the most from the traditional Robert Bork type view of antitrust. And therefore, that's where you're going to see the biggest move back. It won't be completely back to the way antitrust was done in the 1980s and 1990s, but it's clearly a different regulatory environment.
Well, let's talk about what that means for M&A. Obviously, we got the announcement of a new FTC chair. Lena Khan is out despite having the support of J.D. Vance. Andrew Ferguson is in, and it seems like everyone across Wall Street is saying that this is going to lead to this big M&A revival. Would you qualify that at all? What are you expecting in 2025?
Well, I think the most important thing is to realize the M&A cycle was building anyway, and private equity was becoming more active anyway. And so this is an accelerant on top of a cycle that was building anyway. So if you were counting just on this to spur a lot of M&A activity, I think that would have been a mistake. But it's coming on top of something that was already building. And so the first step was the end of interest rate increases, financing markets opening up, bid-ask spreads narrowing. And now we're starting to see, again, sponsors become more active, and then a change in the regulatory environment only adds to. So the environment for M&A looks really constructive as we go into 2025.
I love the Bork callback. I actually have Slouching Towards Gomorrah in the back of my car.
Okay.
I haven't cracked it yet. But
we've been talking about a lot about Icelandic music. It's strange this year.
Let's talk about, you obviously were the head of the CBO and the OMB under the Obama administration. So just big picture, right? The hopes of Scott Bessent to bring our budget deficit down to 3% while continuing to grow the economy at a 3% rate. I mean, DOGE wanting to cut $2 trillion in spending. What kind of effect would that have on growth?
Well, first, I think we have to evaluate what's likely to happen. For example, there have been decades of attempts going back to, I was in the Clinton administration, reinventing government under Elaine Kmark to find waste, fraud, and abuse. Every administration has a variant of this, and it comes in with a lot of hype, and then you get to reality. It's very hard to make substantial progress on the federal budget unless you're touching entitlements, Medicare, Medicaid, and Social Security, or defense. Interest is spoken for, and if you put all of those to the side, you're not left, you're left with about 15% or so of the budget. So it's often not as expansive as the rhetoric suggests. But I think at the heart of your question is, yes, if there was a massive move towards a negative fiscal impulse, that is a lot of budget tightening overnight, that would constrain demand and raise some risks about the growth
Even
target.
over 4 years, Peter. I mean, can you really reduce spending by $2 trillion a year over the term of the presidency?
I've got the under on that. Well, and don't forget, I think the $2 trillion was at least ostensibly supposed to be per year, which is even more unrealistic, but.
What about reducing the budget deficit to 3%? Is that, can you get us down to that in year 4 and still have growth?
It is very challenging to get down to 3% of GDP on the deficit unless there is a substantial uptick in growth. So I would kind of reverse it, which is
I got it.
If we have a growth spurt, then the deficit comes down organically. But under current expectations about what the growth path looks like, it's going to be very challenging because we're going to be locking in lower taxes and because I think it's implausible we're going to be doing very much on entitlements.
Well, when you think about the fiscal picture here and that worry about growth, then how much do you have to worry about the potential for stagflation too? You saw a hint of that in this morning's data. Do you really worry about it?
Not particularly. I think fundamentally the economy is still quite strong. Yes, we had a slightly elevated weekly uninsurance claims number, but in general, the economy is performing quite well with the labor market holding up quite well and growth continuing. The U.S. is the envy of the world right now on the macro economy. So I think the big question on the stagflation front is not the stag part, but the inflation part and what happens on inflation. I would think if we don't do many of the things we were just discussing that would put upward pressure on inflation, inflation will continue to come down, but you can obviously do a bunch of things that are going to head it, make that head in the other direction. And that's why, by the way, it's not just saying that you're not going to even try to fire the Federal Reserve Chair, but also the rhetoric with regard to Federal Reserve independence. The point of the column this morning was to lay out the evidence on central bank independence for whatever other set of policies you're doing, producing lower inflation because of the credibility of the central bank relative to politicians.
And I do want to go back to the M&A landscape, though. Obviously, focusing a little bit more on Lazard, because you were saying, we were talking about that more favorable regulatory landscape coming into effect. But I want to marry that together with the economic outlook, because we talked about the risk of higher inflation. There's a risk that interest rates don't come down that much. So how do those two factors work together? The threat of continued higher for longer rates, but also regulation. Which outweighs which?
A couple things. First, before we get to that, the threat of tariffs also does lead to a lot of cross-border activity. So we're seeing a lot of interest from European companies wanting to invest in the United States in order to avoid even the threat of tariffs being imposed and locate themselves inside of the tariff wall. Now, on rates, look, lower rates are better for M&A, but I don't think it's the biggest driver. Often there are many other fundamental things, reach for scale, technological innovation, et cetera, that are tailwinds, and lower rates help, but they're, as long as we don't see a spike in interest rates, I think you're going to see the M&A cycle really continue. And if all we're debating is the rate at which rates decline, what I said earlier about a very constructive environment, especially with a return to a more traditional perspective on antitrust, will hold.
Well, it's interesting because even with this higher level of rates that you've seen, of course, we didn't see as many cuts as the market expected this year. You're still seeing a tremendous amount of capital markets activity. Tremendous. Lazard was an advisor this week, really, on a $2 billion loan that Blackstone provided to Dropbox.
Yes.
You're expanding well beyond M&A into these capital markets activities. What does this mean at the end of the day? Does this mean that kind of the markets are wide open and debt markets are flush with money and people will keep borrowing at rates like this and there's no worry about this kind of higher for longer environment?
Well, what I'd say is obviously financing markets are reopened, and that transaction that you mentioned is particularly interesting. We have something called Lazard Capital Solutions. It operates at the intersection of public and private credit and other financing markets. And that is what's really interesting is you're seeing more competition now. We've obviously experienced a massive growth in private credit. Public debt markets are also becoming, are reopened. And so helping our clients navigate the trade-offs and creating some competitive tension between those alternative sources of financing is a really promising vector for us.
Blackstone competing with the banks, we are here for it. Peter Orszag, we thank you so very much for your time. That is Peter Orszag, of course, the CEO of Lazard. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Hershey is getting cut to a sell at Wells Fargo. The firm is also cutting its price target, saying that the chocolate company is on the precipice of historic earnings pressure into 2025 and into next year from higher cocoa prices. The analyst says that earnings estimates need to come down substantially. A lot of M&A speculation about this stock as well. Next up, Morgan Stanley is upgrading Equifax to a buy, saying that the Consumer Credit Reporting Agency has an attractive valuation and favorable regulatory environment heading into next year. Shares up about 1.7%. And finally, this is a fun one. JP Morgan initiating coverage of Celsius Holdings with a buy rating. The firm cites the energy drink maker's attractive valuation, also says that the brand has broadened its appeal outside of the typical energy drink consumers to attract more affluent females, rich ladies, I guess, Matt.
Yeah, well, I don't know. It doesn't seem very healthy.
Outside of gaming bros, I don't know.
I'm not a doctor, but
No?
I don't think I would, if I were, that I would recommend someone drink it a lot.
Yeah, it's probably not good for
Shonali
your
drinks a
blood
little too much.
pressure.
I probably drink it every day. Actually, what time is it? It's like 10 a.m. and I have a similar thing on set.
Yeah, just water would be good, you know?
It's better than coffee.
Is it?
I mean, it doesn't make you as jittery. It doesn't dehydrate you. How about that?
Maybe I'll give it a shot. Coming up in the next hour, we'll see what David Costin drinks. We'll also ask him to share the stocks that he likes, the stocks with the highest perspective of risk-adjusted returns, and then we'll talk to the CEO of TradeWeb. This is Bloomberg.
The leader in technology for as long as you have been. Do you think AI is just as landscape changing as everyone else seems to think it is?
Sometimes things are overhyped. I don't think that AI is overhyped.
I think Etsy's uniquely positioned to benefit from AI. Finding that needle in the haystack is tricky. That's part of what makes Etsy both delightful and frustrating to people. And being able to serve the good stuff to the top fastest is where AI can really benefit us.
Our mission is keeping commerce human, and actually we talk about AI as helping us to be superhuman. It's really the partnership between AI and humans that makes Etsy work.
AI can help Etsy's customers personalize their searches and steer shoppers more directly to items they may want to buy. It's also helped the company improve reliability by predicting delivery times more precisely. But that doesn't solve a larger challenge, getting more consumers to think of Etsy more often and ultimately become repeat buyers. To this end, Etsy invented gift mode.
Getting in the top of mind consideration when you're thinking, I have a gift, I'm going to go to Etsy, just getting that to be more habitual. Gift mode provides a perfect opportunity for that. We get to know the gifter, but we also get to know the recipient. So it's a way to, sort of a more viral way to bring in more, introduce more people to Etsy.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Meet Time Magazine's Person of the Year. It's Donald Trump, the man who just rang the opening bell at the New York Stock Exchange.
I have to say, Time Magazine getting this honor for the second time. I think I like it better this time, actually.
Mr. Trump tells Time he's committed to making sure the FDA does not strip access to abortion pills. He also says he's willing to enlist the military to round up and deport migrants. Time's editor-in-chief says, like him or not, Mr. Trump had the most influence on the news in 2024. He was also named Person of the Year in 2016. The White House says the current president, Joe Biden, is commuting nearly 1,500 sentences in the largest single-day grant of clemency in modern history. UVA political analyst Larry Sabato.
No one can change it. No one can appeal it. And so it's a good way for an outgoing president to generate some headlines and remind people that, yes, indeed, he's still there.
Mr. Biden will also pardon 39 people convicted of nonviolent crimes. An American has been freed from prison in Syria, and he's spoken exclusively with CBS News near Damascus today. Correspondent Vicki Barker is at the foreign desk.
A man identifying himself as Missouri native Travis Timmerman has been found on the outskirts of Damascus. He's told CBS's Elizabeth Palmer he'd been detained when entering Syria without permission 7 months ago.
The only really bad part was that I couldn't go to the bathroom when I wanted to.
He says he was not maltreated in prison and simply walked out when the doors opened after the Assad regime fell.
A wildfire is still growing in Malibu, California, threatening thousands of homes and other buildings. Thousands of people have been evacuated. The wind-whipped flames are only 7% contained. Correspondent Carter Evans is there.
Nearly 2,000 first responders at local, state, and federal levels are working tirelessly to establish containment lines. Joining the effort is the Community Brigade, a group of more than 40 volunteers in Malibu, including doctors, filmmakers, and even a judge.
Dick Van Dyke and Cher were among the evacuees. What do we want most in a job?
A survey conducted by Branch, a workforce payments platform, finds that flexibility in all its forms, from hours to work-from-home options, has become the most sought-after benefit for hourly workers. The report also underscores a growing demand for flexible payment options. 4 in 5 respondents reported experiencing fluctuations in their weekly pay.
That's CBS's Jennifer Kuiper. The Dow is up 2 points. S&P down 16. This is CBS News. One lawmaker wants serious penalties for a provocative post-game ritual on the football field.
Ohio Republican Josh Williams says he's introducing a bill to make flag planting in sports a felony crime in the state. It's a reaction to what Michigan players did on the field after their football win over Ohio State last month. An ugly fight ensued.
Get these guys in the locker room.
Williams calls it the OHIO Sportsmanship Act. He says the behavior puts police in danger and has no place on the football field. It was seen before at Ohio State in 2017 after a loss to Oklahoma. Steve Kathan, CBS News.
Celebrities from Paul Rudd to Will Ferrell have lined up to see how much heat they can stomach.
What is a barbacoa? Is that like a chupacabra?
BuzzFeed says it's reached a deal to buy the company behind the show Hot Ones for more than $82 million. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com, and that's where you'll find us. Hugh Worthington's going to join us here, Bloomberg Intelligence European rate strategist. We had the ECB cutting rates yet again today. We'll break that down for you. Ann Berry, founder and managing partner at Threadneedle, to discuss the latest on these markets going forward. Molly Smith, Bloomberg's tennis correspondent. She's also the U.S. economy editor here. She's got a big take story here talking about data, some market-moving data, maybe under threat as Trump returns to Washington. Anurag Rana, he's our tech analyst at Bloomberg Intelligence. Adobe drops after a kind of a tepid outlook. Stoked some AI concerns there for that big technology company, Adobe. But right now, let's kick things off with a Bloomberg Business Flash with Lisa Mateo. Lisa.
You've got in this Bloomberg Business Flash brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and climate indicators. Visit ibkr.com/forecast. Get started today. All right, we've got stocks falling after more economic data. Producer prices rose by a larger than expected 0.4% in November from a month earlier. Now, a big part of that was driven by a jump in goods prices. But from a year earlier, PPI rose 3%, the largest year-over-year increase since February 2023. And more people filing for unemployment than expected. 242,000 applications were filed last week. So we have the NASDAQ down 0.4%, 83 points, 19,949. The Dow down 0.1%, 61 points, 44,087. And the S&P 500 down 0.2%, 17 points, 6,066. The two-year yield, 4.15%. That's little change. And the yield on the 10-year, 4.30%. And that's up 2 basis points. To currencies, the Bloomberg Dollar Spot Index is little changed. Have to point out the euro. It's up about 0.1%. That's after the ECB cut interest rates as expected by 25 basis points to 3%. Moving to Adobe. Shares of Adobe, they're down 12%. Disappointing annual sales outlook showed signs could be feeling the pressure from emerging AI-based startups. Nora Melinda's going to have more on that in just a bit. And after the closing bell, we're on to Broadcom and Costco. Finally, watching shares of Tesla. They're now up about 0.2%, but this is after the stock closed at an all-time high yesterday. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Alex Steele here alongside Paul Sweeney. Yeah, if you were expecting a broadening of the rally in the last week or so to the end of the year, that's not happening. This is all a Mag 7 story. Well, Market Drivers is brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. So let's get to Market Drivers now with Nora Melinda, Bloomberg Equities reporter. Let's break down Adobe a little bit more, because it's always been a question is the AI shift hurting or helping Adobe? And the answer seems to be yes.
Well, shares of Adobe are lower. They're falling for their worst day since March, as much as 12%. Now, this company gave a disappointing annual sales forecast that has really created a lot of anxiety about the company and how it's actually squaring up against its competitors. Essentially, people are really stressed about its AI-based startups. They did actually mention that they have Firefly, which is something that they are rolling out. They're hoping to have add some pricing pressure to and everything. But it really has been not great for the company, especially as a lot of the analysts are really saying that this was a solid quarter, but everyone's really been focused on this guidance that Evercore is saying seems reasonable, but offers no real indication that Firefly and Adobe's Gen I products are going to actually have a positive inflection.
You know, I'm just taking a look at Anurag Rana, Bloomberg Intelligence. We're going to speak to him later this hour. He's going to be on the show. But I'm just looking at his research on the Bloomberg terminal. He thinks this is cautious guidance that they should be able to handle. But he, again, it just kind of suggests that there is some caution around kind of its AI.
Right.
offerings.
That's what I'm seeing from most of the Wall Street analysts. Most sell-side analysts are saying that it seems to be a cautious take, but I mean, you are seeing the stock down as much as 12%, and on the loss in the year down 19%.
All right, Warner Brothers. Paul, this is also your jam. So wait, is this the deal? Like, are they splitting?
They're splitting this thing up, and I think what they're trying to do simply is saying, we know the future is streaming, so let's create a streaming platform. Oh, and let's put our studio asset, which is going to support our streaming business, let's put that into a company, and kind of everything else off into something else.
But it's not being spun off. Like, it's still one.
No, they're just kind of just realigning kind of how they're going to kind of run this thing here, and I think it's Street likes it, right?
Exactly. I mean, we were seeing whispers of this back in July, but most recently what's being reported is that its corporate structure is essentially going to be shifted a bit to create separate divisions, one for cable and one for streaming businesses. Now, the financial advisors on this shift were JP Morgan, Evercore, and Guggenheim. And this is, of course, we know Warner Brothers to be the parent company of CNN and HBO. We're seeing shares of Warner Brothers, ticker WBD, soaring as much as 13%. That's the highest level in a year. So it does seem as though Wall Street is liking it here, especially as we're seeing a lot of companies trying to divide their struggling cable networks from their growing streaming businesses.
Comcast has made an announcement that it wants to do that as well. So again, I think some of these media companies, they're saying, hey, the street kind of likes our streaming business, particularly if we can make some money off of it. So let's kind of make that easy for them to identify where those revenues and those cash flows are coming from. And then the cable networks, which are not growing, that in fact are declining, we can kind of sit them off to the side.
Right, move them over.
Okay.
Wrapping it up, MetLife.
Yeah, we're seeing shares rising as much as 4.4%. Now, it really actually set new profitability targets. This is part of the CEO's new strategic plan for the next 5 years, and it seems as though the street is liking it. Its new targets will support its ambition to grow its group benefits and retirement and income solutions units. And really, people are looking at the CEO to reshape the insurer's business, expanding into its healthcare operations, and did have the acquisition of Versant Health, and it sold off its property and casualty unit back in 2020 to Zurich. So lots of things that people are really seeing here with the CEO, and they're really looking to see how he's going to change things moving forward. We're seeing shares up 26% year to date.
All right.
Yeah, good stuff. All right, Norma Linda, awesome stuff as always. Thank you very much for giving us an update there. S&P 500 off 24 points. Our good friends over in Europe cutting rates yet again, the third straight meeting cutting rates. And it doesn't feel like they're cutting rates from any kind of particular position of strength. There's just some concern about economic struggles across much of Europe requiring lower rate. Let's break it down with Hugh Worthington, European rate strategist for Bloomberg Intelligence. He joins us from London via Zoom. Hugh, again, the third straight time the ECB cutting rates here. What's your take?
Yeah, well, the markets had quite an interesting reaction to it, actually, because I think initially it looked at the headlines that came out of the ECB. As you say, we fully expected the 25 basis point rate cut. But there's a bit of change in language as well, basically saying that rates didn't need to stay restrictive going forward, which I think initially was taken to be sort of, like a very dovish indication. And actually, markets have actually now moved to price a 50 basis point cut at their 30th of January meeting, which is a little bit higher than they had previously, basically being driven by worries about activity data. But right at the end of the meeting, Christine Lagarde did actually sort of put a little bit of spanner in the works and say that suddenly they weren't so confident about the outlook for inflation, and maybe the markets would probably, or people were expecting her to be more saying that there are downside risks to inflation, and that seems to have put the cat amongst the pigeons and basically set the front end bond deals, or bond deals generally in Europe, trading higher again. So they've actually moved in about a 10 basis point range around the ECB meeting. So there's a little bit of mixed messaging going on.
So it was really that last sentence, and let's go through that one more time. So Christine Lagarde said that they weren't as confident in the decline for inflation, that she was worried about upside risk. Is that what I'm reading? It just seems like in Italy, a 10 basis point jump to the upside in the 10-year feels a little extreme on that.
Yeah, I think that also that move might have been a little bit something to do with as well, that people are concerned about this idea of PEPP, pandemic QE redemptions not happening from really, actually, basically, she said next week onwards, and that pressuring the spreads. That may be an element there, but yes, she said that she basically, I think the idea the theory that with a lot of the economist community is they look at the numbers for inflation going forward, and they look like they're as flat as a pancake in Europe. But then she said that, and you know, I think everybody's assuming that basically the risks look really biased towards the downside. And she basically refused to or didn't go along with that track of thinking, if you like. And that came in right at the end of the meeting, and that seems to have just literally, it certainly it made the currency jump, and it made the yields jump. And what I think we've seen is a little bit, whilst we are expecting a 50 basis point cut in January, what markets may be starting to do is just possibly looking for a little bit of a pause or less aggressive cutting cycle thereafter that 50 basis point cut, and that may be, you know, what the people have taken away. We'll see if they sort of try and lean against that as we get sort of reaction, which tends to happen with ECB meetings. But the way they look at market reaction, they may not like it. They tend to sort of try and lean against it in subsequent comments. So let's just keep an eye on that going forward.
So Christine Lagarde, president of the ECB, calling out, you know, weaker than expected economic growth, or just, I guess, maybe persistently weaker than expected growth here. What's kind of the economic backdrop that's got the ECB concerned about growth?
Well, I think we had a. It's actually, people are expecting growth in Europe to be pretty poor for quite a long time, and it's actually held up pretty well. We've certainly had the Olympics in France in the summer may have helped things a little bit, but more latterly, you know, I think there's just the higher interest rates and the situation, obviously, in terms of the energy costs in Europe and the Russian-Ukraine war and everything else has just weighed on things. And frankly, you know, the growth outlook has it's going to be okay in 2024, you know, but it's basically a lot of the PMI surveys and the survey data generally is pointing to, at best, sclerotic growth, and in reality, probably, you know, a little bit possibly risk of contraction again. I think looking at 2025 GDP growth in the latest forecast was 1.1%. That was 1.3% from September time, and frankly, they'll probably be very lucky to be hitting that 1.1% sort of target.
Yeah, which really begs the question also, when do they actually start cutting because growth is weak and they need to support the economy versus inflation has come down, therefore they can remove that restriction. All right, great stuff. Thank you for explaining that to me, because I was so confused all throughout the presser and the statement and then looking at what happened to Italy. So I appreciate you, Hugh Worthington, Bloomberg Intelligence European rates strategist. But it is interesting, you know, you can't argue with the global cutting cycle. Yep. I think we're now just in how deep does that global cutting cycle go and where, and does that actually, should that inform where you put your money?
Right, and 6 days from today, we'll have the U.S. Federal Reserve, and the expectation is for a 25 basis point cut.
Look at you with like the day math.
I got my right there. I got my calendar up there and everything. I'm on top of it. Fed Go is everything you need to know about the Federal Reserve.
All right. Well, taking a look at these markets after yesterday, another record high, but you got to say it was a little uninspiring when it comes to being broadened out. It was really all about big tech. We'll break that down with the S&P down 0.3% with Ann Berry coming up next.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks slipping, and this is after weekly jobless claims rose to a 2-month high of 242,000. Producer prices, well, they posted their largest increase since June. Eggs actually led the 0.4% increase in November. We have the NASDAQ down 0.4%, 88 points, 19,945. The Dow down 0.1%, 62 points, 44,090. And the S&P 500 down 0.2%, 16 points at 6,067. The 2-year yield at 4.16%, that's little change, and the yield on the 10-year, 4.29%, and that is up 2 basis points. The Bloomberg Dollar Spot Index, little change. We have the Japanese yen up about 0.1%, the euro little change, and the British pound down about 0.4%. Bitcoin down about 0.5% at around 101,000. Companies making news. It's Meta donated $1 million to President-elect Donald Trump's inaugural fund, and that's something it didn't do for President Joe Biden or Trump's first term. And Microsoft said it would record an $800 million impairment charge that's tied to its minority investment in General Motors' Cruise robo-taxi program, which is shutting down. And yesterday, that news of the robo-taxi shutdown, well, it pushed shares of Uber lower. This morning, they're on the rebound. Uber is up about 2.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
Lisa, did you call out eggs again?
I did.
Inflation. Ken, what's going on with eggs?
What do you mean again?
Well, because Ken Fellio, our global technical director, he's also like a baker dude, okay? Like business kind of thing. And so he was calling out eggs the beginning of the pandemic. Like that is the inflation indicator that you need, and eggs were going crazy. I'm like, what's it with eggs? Don't they make more chickens? I mean, what's the problem?
It led the increase.
Yeah, just do more chickens. I
don't know. But I'd love to talk to Ken about
his baking.
Yeah, baking pie crust, because I have a really hard time with that. But we'll get to that.
We'll get to that.
Yeah.
In the meantime,
he's not even listening.
Yeah, he's not even listening. All right, Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So head over there. Ann Berry joins us in studio. She's a founder and managing partner of Threadneedle. She invests money for a living. I wrote in our chat, the surveillance chat this morning, I just dropped a note in there. I said, hey, there is a palpable sense of optimism in this country since the election. And I think we've seen it in financial markets. Did you guys change your outlook for investing, opportunities, risk, post-election here?
I actually didn't. And while I'm optimistic, I don't have the same euphoria that I think we're seeing translate into these market outlooks. And one of the reasons actually is pertinent to today, which is I think we're going to see interest rates that are higher for longer than we expected, not just because of the inflation data we saw today, but because the noise around the policies that we think are coming in next year don't lend themselves, in my opinion, to having a rate cut. And I think that changes the outlook for tech. I think it changes the outlook for some of these AI stories that have been getting the biggest pop over the last 18 months. So I don't have the same, embrace of these massive all-time highs that we're looking at for next year.
So the other point, though, is, and we just heard from President-elect Donald Trump, is that we're going to get tax cuts. Yeah. It feels like we're in a very animal spirit place right now. I appreciate stocks are down today, but I think there was a SPAC yesterday, like Bitcoin at 100,000. Like this isn't like a 2018 feel in some respects. Does that offset? How does that meld with what you're saying?
Yeah, well, when SPACs are back and meme stocks are roaring again, then to your point, Alex, you're in this sort of place of, I think we're in a bubble in some respects. Look, I think at a minimum, I think we're going to see the tax cut extensions, right? We know that that's a certainty. I think there's a question now as to whether we really see corporate tax rates coming down to 15%. We'll see what the offsets are with tariffs. But I do think where we still have uncertainty, right? We don't know what's going to happen to big sectors like pharmaceuticals, right, when there's a change in healthcare policy. We don't really know yet what the impact of DOGE is going to be, if we're going to see margins getting squeezed in some big sectors like industrials or defense. So there is this optimism, but I do think that we have yet to understand what specific policies we're going to see from incoming President Trump. And until we do, I think it's difficult to make a real bet.
Where do you see opportunity just in the markets in general? Are there any sectors that are screening well for you guys these days?
Yeah, there's some areas of consumer discretionary that I'm getting more excited about. So there's been a period of real noise around the state of the consumer over the last 6 months. We're getting more data that says it's sort of stabilizing to perhaps getting a little bit better as inflationary pressure abates for the parts of the population that's been hardest hit. Experiential is a place, Alex, I've talked about this with you in the past, that I've always been excited about. And I think elements of travel, the cruise industry is one that was really
Those stocks have done really well.
Really well. And this is one I actually bought, Carnival Cruises is one I bought in the depths of 2020. I bought airlines at the same time. Airlines I hung on to, Carnival I sold out of too early. And the reason was there was a period of time the recovery was much slower than it was for other parts of travel. People didn't want to be cooped up on these ships. There was still that overhang of COVID. And the leverage of these businesses, these ships, when you go buy a ship, you take out massive amounts of debt to finance them. And so I got spooked by the leverage levels. I now have conviction that the free cash flow profile, the margin profile, the ability to take price of this business is back where it should be. The deleveraging is happening. So that's why I've been going back into these kinds of names.
What area, sorry.
No, go ahead.
You mentioned worried about tech then in AI.
Yeah.
Is that really a levered play to rates? People talk about it as it's like a structural change.
I think there are some cases where it is a levered play for rates. I think you've got some AI stories where the free cash flow profile, where the path to profitability remains not obvious. I think there are parts that are not levered plays to rates. For example, the big tech businesses that are already free cash flow generative, where they've gone through this 24-month cycle of cost cutting and they're aggressively reinvesting behind AI, that to me is not a levered play on rates. What that is, though, is setting up 2025 for a real year of show me the money, right? Show me the productivity is coming through in your KPIs. Show me that your margin is truly being enhanced. Show me you're getting adoption and you're taking price, and this is not just becoming table stakes. That, I think, is going to be the big question mark for 2025, is execution turning into dollars.
On the consumer, what's your view on the consumer? How do you think the consumer is doing out there? Because if you're going long a cruise company, I would think it's pretty constructive.
Well, I'll answer your question in two parts. When it comes to cruises specifically, the value proposition for consumers is great. You're getting a vacation at a 25 to 50% discount to the land-based equivalent. So
wait, say that again. On cruise ship, I'm getting a vacation at a discount to the land-based equivalent.
To the land-based equivalent. So if you were to go and fly,
It's a way of looking at that.
if you go to go fly to a hotel, let's say in Florida or Vegas, or you fly to a villa, right? You've got the transportation as opposed to a lot of these places for cruises. You can drive to the ports of call. It's all inclusive. And if you've got to think about it, travel in the US has been really impacted by the cost of labor, by the services inflation that we've seen. A lot of these cruise lines are staffing with international labor. They're going out to nations outside the US to hire their staff, so we haven't seen the same wage inflation that you've seen for domestic travel. So that's why when you're a consumer that's perhaps been pressured over the last year or so, this is actually an interesting value proposition for you if you want to take a vacation. More broadly, though, to answer your question, I've been looking very closely at default rates on consumer credit cards, on auto loans, looking at BNPL take-up, what that means for consumer spending. We saw these default rates creep up over the last sort of 3 to 6 months. It looks like they're now stabilizing if you look at the last amounts of data. So it feels as though there's a little bit of a reprieve coming.
Does that consumer call extend into, say, retail? I mean, talk about stocks on a tear. I can't tell you the number of days that Walmart has been at a 52-week high.
Yes, I love Walmart. I loved Walmart for a long time. I think Walmart's a little bit special, and I think retail, we have to break it down into a couple of constituent parts. Walmart, let's look ahead to next year. Something like 2/3 of Walmart's portfolio, by the way, is US sourced. So if we're now looking at retail and looking ahead to the tariff impact, I think Walmart's particularly well positioned in terms of its scale, its ability to buy at lower cost, but also its geographic mix. You look at retail like Macy's, for example, and what happened yesterday. Department stores are still really, really struggling. You look at certain specialty retail names. I never saw this coming. Abercrombie and Fitch has been on this unbelievable tear. So you've had some Brown turnarounds that have been very successful. You've got other retailers. Let's take the dollar stores, Dollar Generals. They're struggling, right? Their share prices are absolutely in the toilet. So I think, again, it comes back to what is the value proposition? How is the consumer being sliced and diced? And who's playing to their strengths most effectively?
One of my favorite deals back in the day, doing deals, was Live Nation, putting that thing together. You like that one, don't you?
I've liked that for a while.
How the regulators approved that? I have no idea.
Yeah, right?
Yeah.
Anyway.
Live Nation, look, I went into that. I lost money in a bit for a while. I'm up about 40%. But I hung on to it because I really had conviction. This almost is tied into the cruise discussion that as the world gets more digital, as more of our lives go online, The flip side of that coin is people are going to look for more opportunities for differentiated in-person experiences. And Live Nation, and specifically the concert piece, has been a big part of that thesis. I've invested privately in other events-based businesses, music festivals, smaller localized venues, and there's this huge demand for them. I don't think it's stopping yet. Antitrust is a question, the Ticketmaster piece is a question, but for now I'm
They already approved it.
Yeah. Well, they already approved Google's and things, and look, and they're under fire for stuff as well.
You put the largest concert promoter together with the largest ticket agency.
I mean, what do you think was going to happen? What about, we talked about tech and AI, so where do you want to be positioned?
In that sector specifically, where I've been more enthusiastic has been around some of these platformization plays. That's such a lot of syllables.
Yeah, what does that
but
mean?
some examples are, two specific examples. Palo Alto Networks, if we look in the cybersecurity space. So if you take a look at the way in which a lot of enterprises right now have put together their cybersecurity infrastructure, they tended to stitch together lots of esoteric solutions. And if you're sitting in the IT department or the risk department of these enterprises, getting all of these systems to talk to each other, to integrate, to have a holistic solution is really difficult. The Palo Alto Networks of the world are turning up and saying, no, come to us as a one-stop shop. We'll provide all the solutions for you. That's platformization. It's the coming together of all the constituent solutions. PANW has been doing it very well. They've been executing. They're willing to take pricing hits. They are willing to sell at losses to get people to switch over to their platform. It's panning out. It's working. Salesforce has been another one of those. Again, there was a moment where it wasn't looking so bright, but they've actually been delivering on that platformization play. And the reason I like these, Alex, is twofold. I'm on boards. I spend a lot of time on companies that are doing the buying. I know that they're actively looking for these kinds of solutions as buyers, number one. Number two, when it comes to AI, I'm a big believer that the big are going to get bigger, that scale is going to be what ultimately wins in the collection of data, in the scrubbing of data, and the application of data. And so I think these platforms are going to be the big data gatherers and the big winners as we go forward.
Any part of tech that scares you at this point?
Yeah, there are some parts of tech that I feel more on the hardware side, I feel a bit nervous about. And I've done a little bit of a 180 on this because I do believe that there is going to be a reinvestment cycle as a lot of hardware companies, and they're pitching it. The Lenovo's of the world are talking about it. The Apples of the world are talking about it, where AI is now being built into the actual underlying devices. I did make a play to try and go into an industrial hardware around this, an industrial tech, and I think it's just moving a lot more slowly than I would have hoped. So I'm watching that with a little bit more nervousness than I was before.
All right, Anne, great stuff. Really appreciate it. Anne Barry, founder, managing partner over at Threadneedle. And just speaking of, Paul, you know, you're looking at an S&P now. It's what, down 0.3%. Does that broadening out actually happen? It happened for a second. We got a nice mid-cap, small-cap rally there. And then now again, it seems to be dominated by big tech. And I wonder when we kind of settle out and see real direction again.
Yeah, exactly right. I mean, I think you look at the SPX versus the SPW, the equal-weighted S&P 500, a big divergence there. And it kind of seems just over the last couple of weeks, maybe since the election, the outperformance has been from some of the tried and true kind of Mag 7 and some of those communications growth stories.
Yeah, definitely looking into that. All right, coming up, we're going to go to the Bloomberg Big Take story. Molly Smith, U.S. economy editor, will be joining us. Maybe we'll talk tennis. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Bloomberg Interactive Broker Studio. I'm Lisa Mateo. Well, we've got stocks pretty much taking a breather. Traders taking in some more data ahead of next week's Fed meeting, talking about higher than expected jobless claims and too hot producer price data. Right now, we have the NASDAQ down 0.2%, 39 points, 19,995. The Dow, little change, down about 34 points, 44,113. The S&P 500 down 0.1%, 6 points at 6,077. We have the two-year yield at 4.16%. That's little change, and the yield on the 10-year 4.29%, and that's up 1 basis point. A global look, we have the Swiss National Bank. It made a surprising 50 basis point rate reduction, and then the ECB, that met expectations for a 1/4 point of interest rate easing. So I want to check in with the stock 600 right now. It is little change. We head over to the euro. That's down about 0.2%. The Bloomberg Dollar Spot Index is up about 0.1%. Few companies making news. Warner Brothers Discovery, the company said it's restructuring 2 operating divisions. One focused on the legacy cable TV business, the other on streaming and studios. That has shares up about 13%. And sources say NVIDIA added hundreds of staff in China this year. They're focusing on new autonomous driving technologies. And finally, Lucid CEO said it's in talks with multiple automakers about potential partnerships. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We broadcast all the news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries worldwide. And every day, we love tapping the Bloomberg Big Take story. It's a deep dive into the economic and financial stories of our time. And this one comes also from Bloomberg Business Week and comes from Molly Smith, senior economics editor for Bloomberg. And the idea is looking at U.S. economic indicators, right? We trade off, we don't. You guys trade off of them all the time, but there's been a lack of staff, and those that publish the statistics have been pleading for an extra few million people and $1 million, $1 million to help collect the data and process the data. But now they face an even tougher road to that with President-elect Donald Trump. Molly Smith joins us now. Molly, I think it's worth setting the stage for a sec. How do we get this data to begin with? Like, how do we get US CPI? Like, how do we get PPI? How do we get jobless claims?
So there's a combination of ways that data agencies collect the underlying source data. So some of it is through administrative records, and that's what we're trying to move more toward in that data that's already there, whether that's from tax records that identify what kind of businesses there are out there in the U.S. Sometimes we have other companies that provide source data, like J.D. Power for the CPI index submits information on car prices. But a lot of information is collected from households directly in surveying them, and that's really where the difficulty in data collection lies.
Elon Musk and Vivek Ramaswamy have been appointed by President Trump to lead a new, quote, Department of Government Efficiency, or DOGE. Kind of feels like maybe some of these bureaucratic data type of areas of government, they might be at risk. Are there concern there?
There certainly is concern. Not that the president-elect or his team have singled out these agencies as a place for cuts, but they've also said that they want to cut $2 trillion from federal spending. And it's kind of hard to do that if you're not going to be touching Social Security and Medicare, veterans benefits, or defense spending. So that leaves a handful of these other tiny categories left over, and statistical agencies would be one of those. So to give you just an idea of just how small these are in the grander scheme of the federal budget, the Bureau of Labor Statistics, Bureau of Economic Analysis, and Census Bureau, and those are the 3 agencies that I focused on in this story, had a combined budget last year of $2.2 billion. And that's 0.03% of federal spending.
Right. So even if they did cut, it wouldn't really do that much.
This is a rounding error, yes.
So I guess leaving aside any sort of cuts that might happen, is there a more efficient way of doing this in general? Like, someone picking up a phone and calling me doesn't seem efficient anymore. So, like, is there just a better way of collecting data, particularly using, say, AI or other technology?
Well, that's certainly what the BLS and the Census Bureau are trying to do with their current population survey. They've been asking for more money, and we're talking roughly $20 million it would take for this. So you can imagine the pennies that would amount to in the federal budget. But that's roughly what it would take to introduce an internet self-response mode. So this would be a way for households to just go online and say themselves, here's how many people live in this house, here's how many are of working age, here's the people who were working in this week, in this past month, here's people who were looking for work. All of these statistics that right now are gathered over the phone, not so much in person anymore, but that was an even more expensive way of collecting the data that has been now mostly been done away with since COVID.
So what are these agencies saying? How concerned are they? Do they feel like they need more money, or they need to become more efficient, do you think?
I mean, I think they've been asking for more money for years, and the funding process is it's just really challenging for the BLS. They're part of the Department of Labor, so that's more where they need to start pleading their cases to their parent agency, and then the DOL is going to create their whole budget, which also includes a lot of things beyond the BLS, and that's going to then get passed to the Office of Management and Budget at the White House, and then that gets passed on to the president, and then on to Congress, and all along the way, there are people who are looking to make cuts. So it's really just a series of steps that you need to go through, and all along the way, there are people who are looking to cut back.
Here is a horrible question. Why do we need this data to begin with? Like, why do we need it? Like, I understand why regional Fed presidents need it, but they do their own data. I understand why CEOs might need some context, but why does the market need it? Why do we need this federal data?
Well, we, the market, as in traders, obviously, are looking at this all the time. You see the way numbers, stocks and bonds move.
But if we didn't
right
have
at 8:30
what
in
would
the morning.
happen?
I mean, how else can you measure an economy, right? What else is telling you about the state of the economy right now? If you're trying to create tariff policy, how are you supposed to know what kind of goods might be really the place to go after?
But how reliable is
for
the data
that?
we're getting anyway because of the collection?
I think, this is still regarded as among the best in the world. There are statistical agencies all over the world that have seen politics creep into their statistics, and that's really a big concern when you're trying to, this is really a public good, and that's why it's so important that this work is done by governments rather than the private sector. Certainly there are private sector gauges that fill in the blanks, but all of those also rely on government data, not just for accuracy, but benchmarking. They need to have results, namely against a survey of bigger sample to be able to validate what they're looking at as well. And if we're just talking about regular everyday people, I mean, this is so important to see, where are you going to move in this country? Where do you want to live? Where are the best jobs in this country? What kind of skills are needed to perform those jobs? If you're just graduating high school and looking to join the workforce, like, what kind of skills are needed and what kinds of fields? So this is all hugely important. Local politicians as well. Where will they build housing and hospitals? So it goes beyond financial markets for sure.
All right, Molly Smith is our U.S. economy editor, but she is also
there we go. Okay.
the tennis guru here. So we've got like a minute left. What are you looking at in the world of tennis here today? What should we be focused on? Who should we be focusing on? What's the next big thing in tennis?
Obviously, Australian Open at the top of next year is high on my bucket list, but I will be watching from the East Coast roughly at 3 a.m. Eastern time here in the States.
So who's the new star of men's tennis? The big three are effectively, I guess Djokovic is still around.
He's still around. I mean, Alcaraz and Sinner are really the best by far right now, and Zverev somehow has managed to creep his way into the top 3 in the world. I will save my thoughts on that for off the air, though.
And how about oh, interesting. How about on the women's side?
I mean, I think Aryna Sabalenka definitely belongs at #1 right now. She looks pretty unbeatable, especially on hard courts, and would like to just see some of these Americans maybe break a bit more into the fray. We already have 4 in the top 20, and certainly could think there would be more in the top 10 by the end of the year.
All right, very good. Molly Smith, U.S. economy reporter, also our tennis expert. We rely on her heavily during the big Grand Slam matches, especially the U.S. Open here in New York. So we're looking at that here. Markets, S&P 500, off about 9 points here, kind of pairing some of its earlier losses. The Dow off 63 points, and the NASDAQ off 35 points, all about maybe 1/10%, so not much movement there. The VIX coming in 13.5 there. 10-year Treasury yields up a couple of basis points, 4.29% on your 10-year. WTI crude oil off 1.25%, now below $70 a barrel. Bitcoin, $101 1,000. How about that? That's coming up just below 102,000. We're going to have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, happy Friday Eve. More importantly, Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. Let's get to Adobe right now because that stock is off by about 13% after earnings yesterday. Anurag Rana is Bloomberg Intelligence technology analyst, and he joins us now. Are the numbers we got match up with a 13% fall in the stock today?
So when you look at Adobe, it's very similar to what's happening with other software stocks right now. Expectations are very high going into the quarter, and we don't know how tech spending is going to shape up next year. So companies are giving a very conservative guidance going in. There's a particular key KPI or a key metric called digital media annual recurring revenue. Last year, this metric grew at 13%, and the company is guiding to 11% growth next year. You know, in our view, this is the way you want to start a year. You start at 11, and then you accelerate throughout the year. But it seems that Street was expecting much bigger, AI numbers from Adobe, and that's the reason why stock's going down today.
Anurag, all right, here's the dumb question of the day.
Never.
I've heard the name Adobe. I know the name Adobe. It's a big, big name in Silicon Valley. Can you remind me what it does?
Yeah. So if you look at it in the most simplistic way, they have one of the most amazing products in software called Photoshop, and that's it. I'm just saying that's one of the products, and they also control the PDF market through their document cloud business. That's really the cash cow of this company. That's what generates the biggest margins, and that's really where everybody's eyes are. Because the biggest argument on Wall Street right now is whether Adobe is a beneficiary of Gen AI or are they a victim of Gen AI, and that's the big question is, can they survive when somebody's going to take a large language model and create a video on the fly or create a picture on the or a photo on the fly, and that's really hurting the, you could say, just the prospectus of the company in the long run.
So twofold question on that. One is the stock action and its continued numbers show us that it can't compete with Gen AI, or do we not know yet? And if we don't know, when do we know?
Yeah, I think this is going to take a couple of years for those Gen AI push from their side to show up on the numbers. And frankly speaking, Salesforce, I think, did a better job of communicating that to the street, that, Salesforce launched Agentforce, but that's not going to have a material impact on financials, at least for the next 12 to 24 months. And Adobe should have done the same thing, honestly, that they are launching a lot of AI capabilities, but with a revenue size of, 24 billion or so, it's not going to be easy to move the needle. And I think that's where there is some gap in communication. And, in our view, 11% is not bad, honestly, going into next year, but market doesn't like it.
So step back a little bit, Anurag. I know you guys at Bloomberg Intelligence, you have some really good data as it relates to technology spending from an industry perspective. What's the outlook for 25, 26 in terms of tech spending overall?
So I'll be honest, I'm going into 25 with a little bit of optimism that finally, after 2 years of muted spending, we may see a rebound. And the reason we think is it's a pent-up demand. It's never happened, at least in the 15 years I've been looking at tech spending so closely, just in the last big boom, that we have seen 2 years of spending not going up. So I'm optimistic that's going to happen. Now, with that, that's going to most likely flow in the Feb-March timeframe when companies launch their technology budgets and really figure out what they're going to do next year. We also think Gen AI investments are going to start to accelerate even more, moving away just from the infrastructure side to creating applications. And I think, that's going to help the software space as well.
So does that mean that IT budgets grow and there's just more of the pie to be spent? Or are we going to see money then coming out of, say, the sexier AI stuff and into more traditional things?
We think the pie is going to grow because I think it's going to be very difficult to take money out of AI and put anything else. What we have been seeing over the last 24 months is money has been coming out of traditional software and traditional services like consulting and going into AI investments. We think the entire pie goes up next year, and companies like Salesforce and Oracle and Adobe should see some benefit from it. Another reason for our optimism is we are hoping that the interest rate decline continues, and then what that can do is that can really fuel up the small and medium businesses that have been so far left behind and not spending at the same rate because the cost of capital for them is too high.
Salesforce stock year-to-date up 35%. Adobe stock year-to-date down 20% here. Is this a messaging problem, or is it really to reflect that, Adobe's business is more at risk than, say, Salesforce?
I think it's a little bit of both on the second side because if you look at it, this is, as I said, this is the most controversial stock in the software space right now. And before Gen AI came in, this was the #1 stock. It was actually valued higher than Microsoft for several years because of the stable nature of the top line and very high margins. I think management just has to execute well in this case and showcase that they are not going to be left behind with Gen AI, but they're going to be a net beneficiary of it as well.
And I know you might not cover it, but Broadcom is out after the bell. What do you think? What are you going to be looking for?
I think, and again, as you said, I don't cover it, but the semi space has been a lot more volatile in recent months because of the backlog and what kind of orders they're getting. Because on a macro side, while Gen AI is pushing some of the demand for the semiconductor space, but areas like automotive and industrials are still struggling a little bit.
Paul's laughing at me because I'm taking notes as you're talking because you don't cover it, but you know stuff, and I might be on TV when Broadcom breaks. So it's all part of my master plan. Thanks a lot, Anurag Rana, Bloomberg Intelligence Technology, Senior Technology Analyst, joining us there. Honestly, one of the best when it comes to analyzing technology stocks. Taking a look at the markets here, we're looking a little bit softer. Equities, NASDAQ off by 0.2%, but we hit a record yesterday. The S&P is off 0.1%. Volume is a little bit mixed, and just taking a look at the bond market after that sell-off over in Europe, you're seeing yields rise just a touch. We get a 30-year bond auction, $22 billion coming at 1 p.m. So we'll be looking at that takedown. Much more coming up on Bloomberg Intelligence. A whole nother hour of great analysis coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. Happy Friday Eve. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We have a great second hour lined up for you. We're going to dig more into eggs because that was a big concern in PPI. Mike McKee, Bloomberg International Economics and Policy Correspondent, will be joining us. Plus, George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense and Airlines Analyst, will be joining us. And the FAA Chief stepping down from that regulator position next month. Plus, we'll talk more real estate with Sonny Kelsey, Co-Chief Executive Officer over at BGO, and Leland Miller, CEO at China Beige Book. Are we looking ahead for some more stimulus out of China? I feel like I've been saying that for years, but will next year actually be that moment? Will we get more rate cuts as well? But let's kick it all off for you right now with the Bloomberg Business Flash with Charlie Pellet.
Hi, thank you very much. And here's what's going on. We've got stocks lower across the board on this Thursday morning here. PPI Thursday, S&P right now down 8, drop now of 0.1%. We've got the Dow Jones Industrial Average down 39. That is a decline of about 0.1%, while the NASDAQ Composite Index lower right now by 39 for NASDAQ, a drop there of 0.2%. Russell 2000 Index of small cap shares lower by 0.6% with the 10-year, 4.29%, the 2-year, 4.15%. Spot gold retreating by $36 the ounce, down 1.4%, 26.81, while West Texas Intermediate crude down now by 1.4%, 69.30 for a barrel of WTI. Bitcoin at $102,000, up another 0.4%. Lots of economic data this morning. Applications for unemployment benefits rose to a 2-month high at a time around the end of the year holidays when data is volatile. Initial claims up by 17,000. As for the labor market backdrop, Julia Pollack is chief economist at ZipRecruiter, which is out with its employment outlook for 2025. And she was interviewed this morning by our Paul Sweeney on surveillance.
The vast majority plan to expand hiring. The vast majority plan to raise wages, about 1 in 4 very substantially, with 5% increases or higher planned for the year.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. After earnings, Adobe now down by 13%, a stock we were just talking about, and Ciena surging by 14.5% after the conference call this morning. Our Nora Melinda will have a whole lot more. She'll take you beyond the headlines on those stocks coming up in just a moment. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we are live in our Bloomberg Interactive Broker Studio here in Midtown Manhattan. We are streaming live on YouTube as well, so check out youtube.com, search Bloomberg Podcast, and that's where you'll find us. Norma Linda joins us. She's equities reporter for Bloomberg News. She joins us here in our Midtown studio. Nora, what are you looking at? What stocks are you looking at today?
Well, I'm keeping an eye on Ciena Corp. That's ticker CIEN. It is a developer of markets communication network platforms. We're seeing shares rising seeing as much as 22%. That's the highest that the stock has seen since 2002 and its biggest intraday gain in 5 years. Wall Street is loving some commentary that they got from its CFO, where they said that it was a very strong start for orders in the first quarter. So they did have fourth quarter results that missed expectations, but the CFO really underscoring the fact that orders should be strong in the first quarter has really had Wall Street liking it. I mean, we're seeing this being a great year for shareholders more broadly, the stock jumping 85% in the past 12 months.
Wow. That's a move. Okay, Adobe, on the flip side, we just talked about Anurag Rana, but we're also kind of looking ahead to Broadcom, and I appreciate they're totally different businesses, but that's all still the AI story pervasive.
Most definitely, and I think that's been the story of the year. I mean, as we're looking at Adobe, of course, the concern is AI and how much they're actually keeping up with their competitors, especially as they're thinking about generative AI and how they're using it, and some of their things that they have going on, like Firefly. We're seeing shares of Adobe down, tumbling for their worst day since March. They're down as much as 13% and have lost about 20% year to date. So lots really riding on this company and people really seeing whether it can actually compete and hang in with the big guys.
How about our friends over at Uber? Again, I arbitrage Uber versus Lyft, whatever gives me the lower price.
You and me both. Wait, and you guys notice, is there like a pattern or is it super random?
Fairly random.
Likewise.
But material sometimes, 10, 15% difference.
Oh, wow.
Yeah.
And I think sometimes if you leave the app open long enough, at least for Lyft, you'll start to see, oh, you get a flash discount sale. And so sometimes I'll do that, but I don't really have any brand loyalty when it comes to Uber and Lyft. It's whoever's the cheapest and can get me where I need to go.
Because they're the same drivers and same cars.
It's just a lot of people overlap.
Matt Miller doesn't do that. He's an Uber person. He doesn't arbitrage.
Oh, wow.
Yeah,
Knowing how much I like sales,
or something.
I'm weirded out by the fact that I don't do this.
Yes.
Because it feels like that should be in my DNA.
It is an extra step.
For sure. And then there's Curb, if you guys have heard of that,
Yeah.
the taxi app. Sometimes I see some cheaper
yes.
options there as well. But when we're looking at Uber, shares have risen 3.9%. That's the most since October. And this is after TD Cohen actually sat down with the CFO there, and they're saying that that the mobility business, UberX, should see growth of low to mid-teens year on year as driver numbers increase. So they really did highlight other growth drivers such as Uber for Business, Teens, and Uber XXL. They're flagging that Uber appears to be ahead of its own gross bookings targets outlined in the February Investor Day. But I mean, shares of Uber have only gained 1% this year.
That's interesting. All right, Norm, thanks a lot. Really appreciate Norm Melinda joining us. Bloomberg Equities reporter. Appreciate that very much. Okay, to the economic data of the day. You're looking at PPI. If you back out food and you back out energy on a month-on-month basis, came in up 0.2%. But if you keep it all in there, you take a look at PPI final demand up 0.4%, and you have to wonder kind of what's going on. And how's the right way to take this on a year-on-year basis? Final demand was up by about 3%. So Mike McKee, Bloomberg International Economics and Policy correspondent, joins us. Literally no one better, and I know that because he's my BFF and emails me things all the time, like price of eggs, Alex, that really contributed to the PPI.
80% of the headline PPI was due to goods prices going up, and the majority of that was egg prices, up 56% in the month. It's avian flu. And it has happened.
Because Paul's like, why can't we make more chickens? Which, you know.
Well, we do, but then we kill them all.
Yes.
Because they get avian flu. That was the major contributor, and that's the biggest reason that the core is so much less. The important thing for the Fed is that the categories that they take from PPI and put into the calculations for PCE all were much lower, like airfares, insurance, things like that. So the outlook is much better than it looks on the headline basis.
So net, December 18th, we're still expecting, I guess, a 25 basis point cut?
We haven't seen any reason why we wouldn't at this point. A couple of Fed officials have said they would be ready to pause soon, but they haven't said when that is. So given that most of them have suggested they're still on track to cut rates, that's the bet.
Here's my question. I feel like this is a day 2 story of the CPI that we got yesterday. Is that, I mean, inflation isn't conquered. Like, it's not. So why the still impetus to cut in a more aggressive way?
Well, I don't know that it's any more aggressive. It's what they had laid out, and it's 25 basis points. They're not going back to 50.
But why even cut it all when we know that inflation isn't?
Well, that's
licked?
what the pause folks are saying is that we still need to make sure that inflation's going down. And the answer to that from the other side is that inflation is going down, and it would continue to go down given even a lower interest rate. And one of the things they can point to from the CPI is that owner's equivalent rent, the crazy way the government calculates housing costs, went down to just a 0.2 rise, which is the lowest since January of 2021. So they have been waiting for housing prices to roll over, and it may be that they're finally doing that. And if that's the case, when you back out housing from the CPI, you're pretty much at 2%. So the odds are they can, they're going to look at that and say, we can cut some more. Not as much maybe as we thought we would. Neutral, maybe higher, but we can cut some more.
We also had jobless claims that came out today, the highest in a couple of months. But I don't know, as long as I still see like a 220, 230, 240, I don't know. What did you take away?
You're in a range. The thing to remember about jobless claims this week is Thanksgiving was the prior week, and everybody took 2 days off, so nobody went and filed jobless claims during that Thursday and Friday, and so they all go last week when the offices reopen and we get this bump.
I hadn't thought of that. Did they teach you that in like economic school?
Yeah, there's a whole class in holidays. No.
How does that work?
Holiday seasonal adjustment. It is an issue.
Called experience.
Especially this time of year because the holidays float. They're at different times every year. And this was a very late Thanksgiving, which impacts retail sales.
Shorter holiday season.
That.
Yep, we heard that.
Okay, so what are you looking at next? So we're going to get the Fed on Wednesday, but then what? I mean, like, what's going to be that market moving moment?
Well, we're going to want to see what happens with retail sales next week, which is the same day as the first day of the Fed meeting. Retail sales are expected to have risen. People still hanging in there, still spending money. And if that's the case, then that puts us in line for continued stronger than expected growth, which should be, in theory, inflationary, but raises the question of productivity. Is that rising and absorbing some of this? So a lot to look forward to in the numbers ahead. But after the Fed, I think everybody looks forward to Christmas.
Yes.
And Hanukkah. And we will get PCE at the end of the month, but we will beyond that not get anything that's going to move markets.
That's basically like, we're not really going to do much until the new year. Fair enough.
Who's working that week between Christmas and New Year?
You are, Paul.
I am.
You are. He
Boom.
does it because he takes every Friday off in the summer. So
that's true.
Just saying.
Yes.
There's an idea.
Well,
yes.
Yeah. I mean, hey, it works at some point. All right. Thanks so much, Mike McKee, Bloomberg International Economics and Policy Correspondent, joining us there. Okay. Another story I want to pay attention to is what's going on in the airline industry. Apparently, the FAA chief will be stepping down from the regulator next month. Joining us, George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. Michael Whitaker announced this plan to leave office in a letter to staff on Thursday. An unexpected move, though, a little more than a year after he was confirmed by the Senate for a 5-year term. What do you think?
Yeah, I mean, I think he's, we've seen this from other positions, where Donald Trump would have the ability to put a political appointee in. A number of them are resigning sort of in advance, maybe out of expectation they'd be asked to resign. But, I think Whitaker's done a good job. The noise I've heard out of Congress is that they've been happy with the work he's done. He's only been there a year. I think there's certainly a replacement out there for him that can do as well. So you like to see continuity in these jobs as much as you can, but not irreplaceable.
George, let's get to some companies here. Boeing, they're back to making the 737 planes again, aren't they? Is that a good thing? And kind of what's the near-term roadmap for our friends at Boeing?
Yeah, so it's definitely the path to recovery, right? And they need to generate some cash and knock down some inventory levels. And so it's a positive from that standpoint. Yeah, we looked at November deliveries. We published actually this morning on that. Very light. Most of what they delivered looks like it had been built prior to the strike. So it looks like they're kind of taking their time coming out of the strike, making sure the factory is in good working order. Airplanes are coming out, thoroughly manufactured, safely manufactured. I think that would be a positive. I expect that they'll ramp this cadence up as they get into 2025. We've published our report, too, on what we think we're going to see from deliveries out of Boeing in 2025. We think there'll be a 45% increase in 737 deliveries. We think by the end of the year, they could be around that 38 number, which I think is the magic number the FAA has allowed them to go to before more approvals.
Thinking out of the box, because we always forget that you're also the defense analyst for Bloomberg Intelligence. We focus so much on the aerospace. What's your outlook for the defense contractors in 2025 when we're all trying to get a read on what policy is going to be?
Yeah, so I think defense contractors have a really strong tailwind behind them, right? And so my team and I, we look at both the U.S., European, and some Asian defense contractors. We see a lot of purchasing out of Europe, right? We see a world where Europe sort of has to step up, spend a lot more money to be more of an equal weight. They've got a long way to go to get there, to be an equal weight with the U.S. and manage the threats around the world. You know, the big threats are Russia aggression, Iranian aggression, challenges in, in Asia as China rises. So it looks to us like the U.S. really, under a Trump administration, turns and focuses more in Asia. And I think Europe would be expected to be ready to hold their own in Europe, against the Russians. And so we see a lot more buy out of those European governments. We see budgets rising. The U.S. budget, I don't think, is going to rise significantly, but continues to tick higher, and that keeps our defense establishment working busy too.
So that's kind of where I wanted to go, George. I mean, we all kind of have the understanding that a Republican administration, particularly one that has a Republican Congress, that's got to be bullish for defense spending. Is that what you're hearing from the defense contractors that you talk to?
So, the sense that we get really is that I think Donald Trump will try to take a little more of an isolationist turn. I almost think of it sort of as a Reagan-esque turn, where he'll want to focus more on the weapon systems that are maybe more strategic. Remember, Reagan was very focused on Star Wars. I think Trump could be very focused on things like missile defense, things that are building up the Navy. Won't necessarily want to engage troops on the ground. We've already heard him say he doesn't think Syria is part of our fight. So we see sort of less on the ground engagement, more of that upper level strategic engagement. Again, I think that'll keep U.S. defense contractors busy. Do we see leaps in defense spending? No, we don't see the budget supporting that. And again, I think that's part of his rhetoric, where he goes to Europe and says, you got to spend more money to be ready to defend yourselves, because he doesn't want to spend that money to defend Europe, and he wants Europe to help pull some of the global weight on, for democracies around the world.
We have like 30 seconds. Is there a top play in the defense sector that you feel is best positioned right now?
Well, I mean, what we see is backlogs and revenue rising at a lot of those European defense companies, and so I think that they've got a lot of good tailwinds behind them.
No, fair enough. Yeah, because they got to be spending more as well. All right, hey George, really appreciate it. Thanks so much. We chatted something not Boeing. We started here, but we moved on. It was interesting. All right, George Ferguson, Bloomberg Intelligence, senior aerospace, defense, and airline analyst. All right, coming up, Sunny Kelsey is co-chief executive officer of BGO. We're going to talk more of the state of commercial real estate, where it's going in 2025, and what it has to do with the rate profile. Taking a look at these markets, we are trading a little bit mixed. I say mixed because we're not really going anywhere fast, but the S&P is off by 1/10, and the NASDAQ is off by about 0.1% as well. And the Dow Jones is flat on the day. You're seeing the bond market a little bit heavy, yields a little bit higher within the market, following European yields that are surging. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 index does remain in the red. We are off session lows, but right now we have got the Dow Jones Industrial Average just turning higher, reversing earlier losses. Little change, but up 8 points right now. The S&P down 6, lower by 0.1%. The Nasdaq Composite Index lower by 37 points after yesterday's surge, falling by just about 0.2%, just below 20,000 now at 19,995 on the Nasdaq Composite Index. 10-year at 4.29% with a 2-year 4.14%. Gold down $37 the ounce to $26.80, drop of 1.4%. West Texas Intermediate crude oil down 1.3%, $69.36 a barrel, and Bitcoin 102,458 on Bitcoin, up now by just about 0.8%. Meta Platforms has donated $1 million to President-elect Donald Trump's inaugural fund, part of an effort to build a positive relationship with the administration after a tense history. Meta owns Facebook and Instagram. Meta Platform shares today are higher, up by 0.3%. Again, recapping, the Dow higher, S&P lower by 6, down now by 0.1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pelleton, thank you so much. We appreciate that. Alex Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and we're streaming the video thing to YouTube. I understand that's a big business, YouTube. So head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. Alex and I, we love talking about the world of commercial real estate. There's so many aspects of commercial real estate. I ignorantly just think of office real estate, but there's so much more out there. Sonny Kalsi joins us here in our studio. He's a co-chief executive officer of BGO. Sonny, thanks so much for joining us here in our studio. Commercial real estate, where do you guys have exposure to commercial real estate these days?
Thanks, Paul. It's great to be here again. Globally, so we're $85 billion. About half that's in the U.S. and half that's non-U.S. Okay. And it ranges a gamut of, we have some office, but fortunately most of what we have, the vast majority of what we have is not office.
Good. So where are you seeing the best opportunities these days? Because, boy, the last 4 or 5 years in your business, been tough. Like a lot of businesses, has been tough.
Been tough, especially the last 24 months. Where we see a lot of inflows right now, really two big areas. One is credit. Okay. So real estate credit, 20 billion of our 85 billion is, we're a lender. And that has grown a lot. That's probably.
So you go out and raise funds to then?
We raise funds. We have a balance sheet from our 51% shareholder Sun Life, and so we can lend on their behalf. But we raise funds. We do that, and then we've had a lot of momentum in certain niche strategies. Well, one is Asia. Okay. We've raised a lot of money. We raised a lot of money for our Asian business. And then like something like cold storage, cold storage, which is temperature controlled distribution or logistics. Just think about it simply. If you order anything from Amazon Fresh or Fresh Direct or something, it's got to come from somewhere. Right? And so that's been a big growth area too.
I just assumed it was, I don't know where I thought it was.
You thought it was coming from the back of a Safeway, but it's not.
It's not. Okay, very good. All right, so let's say I'm in local town USA. I'm a real estate developer. I think there's a need for multi-family condos or whatever. Yeah. Is my local bank going to lend me the money to do that?
It's harder. It's harder for them too. I think given the regulatory environment, and especially going into 2025 with Basel III coming in, it's been tough for the banks. So the banks, basically the big banks all pulled back 4 years ago. The regional banks filled the breach. We know what happened to the regional banks a couple of years ago. That's why the private lending market has really grown a lot. Private lenders have come in and really filled.
But I don't know the private lenders. Do I have to come to New York City and talk to you, sharpshooters?
There's all kinds of intermediaries.
Because I like going to Valley Bank. Yeah. My local banker who's at the Rotary Club with me, he's going to lend me money so I can build.
And he might, and they will. And they will do that as much as they can up to the limit. But then there are all kinds of intermediaries and brokers who will introduce you to people like BGO and others.
So what other areas within the CRE market do you think are going to continue to do well in 2025? And is it predicated on lower rates at all?
It's 100% predicated on lower rates. It has to be. Yeah, look, I mean, that's been the big headwind for commercial real estate, broadly speaking.
But everyone's always going to say, but warehousing and AI and data centers, like they're irrespective of rates.
They've done relatively better, for sure, notwithstanding rates, because they have growth. But I think for the sector to broadly come back, we need a better rate environment, a more constructive rate environment. Say that.
Well, what other areas do you think that could do well next year?
So I actually think everything will do better next year. Right. So let me just start with that.
Okay.
I think we've gone from a period where for the last 2 to 3 years we've had significant headwinds, and I'm mostly talking about U.S. right now. Headwinds to real estate, those are turning, right? So rates are down some. It is unclear what's going to happen in the rate environment going forward. You've had other people are more proficient about talking that than me on, but if rates come down and continue to come down, it's a big tailwind for real estate. And that's been the big issue. The bigger issue for real estate has not been the macro environment in terms of what's going on in terms of leasing, et cetera. It's been capital markets. The capital markets have been frozen more or less for real estate for the last couple of years because of rates. Rates come down 50 basis points, 100 basis points, it's a huge shot in the arm for the industry.
So where do you get your capital then?
We get it from a lot of different places, and it costs us more, right? So we don't lend to ourselves, but we will borrow from other people that look like us. You know, and I would rather be borrowing from J.P. Morgan, because J.P. Morgan's got a lower cost of capital, and you know, as do all the banks, but they haven't been as active in the space, which has created a big opportunity